7 basis points. We'll dive into that through the show as well. That's important. John Farrow on assignment, Lisa Abramowitz and Tom Keene. Stay with us on radio, on television. This is Bloomberg Surveillance. Good morning.
The top names in climate change are on Bloomberg.
I want everybody committed to the kind of action that we need. We have a global emergency now. You know, we're still putting 162 million tons of man-made global warming pollution into the sky every day, using the sky as an open sewer. That's trapping as much extra heat as would be released by 600,000 Hiroshima-class atomic bombs exploding every day. That's what the scientists tell us, and the data shows it. That's crazy. That's why we have a third of Pakistan underwater. That's why we have the historic heat wave in China, nothing comparable to that ever. That's why the heat records are broken every year. And we're seeing an increase in the flows of climate refugees crossing international borders that are due to vastly expand unless we take action to solve the climate crisis.
Nobody covers climate change like Bloomberg, your global business authority. Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals. Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis, weekdays. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
The markets are fighting the Fed, as they've frankly been doing all year. I think the market is, more aware of the upside risks and is happy to maybe look through, maybe 1 or 2 more hikes. Whereas the Fed, I think, is going to be hanging on till absolutely the last moment. They don't want the market to loosen financial conditions off, prematurely.
Ben Laidler there, the bull. There's no question about that. You got to be in the market to participate. And Ben Laidler has done that. We thank him for his appearance today. Market Patel at 6 o'clock was in a different way, but equally as constructive as Mr. Laidler.
Which I'm struggling with a little bit, not because it flies in the face of all the bearishness earlier this year, but because there is an increasing discussion about stickier inflation, consumer tolerance to price increases, necessitating a bigger response that curtails the growth. This is the tension to me right now, underpinning a market.
There's huge tension. I totally take that point.
That does want to melt up.
I really agree with this, folks. Into 6:30:23, this is a huge point of tension. And I would say the major tension is the percentage of people that are not enjoying SPX up 14 or 16%, plus or minus 200 beeps.
What Neil Shearing just said of capital economics was fascinating. This economy hasn't been so resilient. There are pockets that have been decimated, and there are pockets that have been incredibly strong. And this is the issue with trying to come top down and come up with these assumptions. How do you understand such a bifurcated economy?
Well said, Lisa Abramowitz. Farrell wouldn't have said that. I mean, top down, folks, and then there's bottom up. We're going to do it right now. Market check, we're flat. The VIX under 14 is a shock, 13.72. We'll get into all that later. I'll do a complete data check here at some point. This is a joy. There's a thing called Starmine. The Wall Street Journal with the great Fred Wegold missed every day. The great Fred Wegold invented the Wall Street Journal Beauty Contest, which was really important. I personally saw that change people's lives. And there's a thing called Starmine that was even more accurate, and that changed people's lives as well. One of them was a guy at Prudential a long time ago, Lee Klasko, who we all read surreptitiously. We don't want to talk about it, but yeah, we're bored with freight. Boring freight. And then FedEx exploded onto the scene, and Lee Klasko became truly an expert on logistics across America. He's brought that to Bloomberg Intelligence, and we're thrilled. He's here. There was like freight before FedEx, and then there was freight after FedEx. When you were doing the grind, what was it about FedEx that was shocking when Fred Smith invented the company?
Yeah, well, we like to think we were bringing freight back to being sexy, but Fred Smith really created a new industry when he created FedEx. He invented the air freight industry, and so FedEx is a very interesting network because it's an air freight network that then decided to be a ground network, where UPS is the opposite. They started as a ground network and then decided we want to get into the air freight business. So some of the nuances between FedEx and UPS are kind of based on where their roots are initially started. And Fred Smith now is kind of has taken a step away from the company. He's still involved as an executive director, but from the day to day, he's doing a lot less. And so, I think we're entering a new chapter in FedEx, which is actually a good thing because FedEx has gotten a little bureaucratic, a little fat, if you will, over the years.
And it was always relying on growthiness to it, because the heart of the matter is like Kroger's, it's a 4 cents on the dollar business. I mean, the net income line and even EBITDA is not all that great. The new FedEx, what did you learn yesterday in the earnings report about this transaction from the bloated FedEx to some new beast that can do better?
I think they're making incremental progress, which is a great thing to see. I mean, incrementally, they're reducing costs. They have longer-term $6 billion in costs that they want to take out of the company. They're also reducing their CapEx from last year, and that CapEx is going to go down over the next couple of years, and that's really driven by the fact they don't have to buy as many planes as they once have. They're in a process of modernizing their planes and their fleet, which will improve their overall fuel efficiency and their ability to meet changing demand dynamics. But those needs to buy those new very expensive planes are reducing because the age of the fleet is being reduced, and those really uneconomical old MD planes are being retired.
Before we get into the nitty-gritty, you asked the question, you started with talking about the distinction between FedEx and UPS and the other freight carriers. Is FedEx representative of the overall economy for goods in the same kind of way that it used to be, the same kind of way that UPS is?
Sure. I mean, absolutely. Because, they cover B2C stuff. They cover B2B stuff. They also cover freight for the industrial economy. They're one of the largest less-than-truckload carriers, which is really synonymous with the fact of bringing manufacturer, industrial production goods to market, in addition to e-commerce and other end markets.
Given that it does have a finger on the pulse in that kind of way, is there some signal from the fact they could raise prices for consumers quite considerably? That wasn't the issue with the reduction in their profit forecast. But volumes are going down in a much more material way than a lot of people had previously expected. Does that tell us something deeper about the economy, particularly with respect to goods?
Well, I think it's interesting when you look at the freight market. We've been in a freight recession for a couple of years now, maybe a little over a year, we'll call it. And that's really across all modes. So if you're looking at truck tonnage, you're looking at truck loads, you're looking at railroad loads, or air freight, anything, container liner. And that's really because we're getting to a new normal of freight demand. As you well remember, in the pandemic, everyone was buying stuff. There was a huge rush. There was a dislocation of the supply chain, which created increased demand, and people were panicking, oh my God, I need something tomorrow. And now we're just getting back to a new normal. And so when people say, volumes are down, the sky is falling, I would just say it's not. We're still better than we were prior to the pandemic.
What I find interesting is they're still able to raise prices.
Yes.
And it doesn't seem, particularly in the airline industry, perhaps also in the freight industry, there hasn't been that much consumer pushback to price increases because people have gotten used to them in the post-pandemic world. Is that what you're noticing? That there isn't necessarily the consumer pushback that some people would expect to pay more to send their packages, even if they're sending fewer of them?
Yeah, and I think also a lot of people have the perception, which is true, that inflation is real and people need to increase their prices to generate a decent ROI. And so, and they also, let's not forget, they are a duopoly, right? So they do have that pricing power. And they also can be more selective in what kind of freight they're taking. If customer A does not want to take a rate increase, maybe they will decide not to do as much business with customer A versus customer B, who was willing to take a 3% GRI and committed to, a certain amount of freight per year, which is something that FedEx or UPS wants because they wanted the predictability of their network.
I took a log regression of FedEx back, and it's remarkably on trend going back 20 or 30 years, coming off the October low and a big surge up here. I know you don't do buy, hold, sell, Lee, But is this a company that you see, frankly, like UPS, where there can be a return to FedEx exceptionalism that we were weaned on, or is logistics just going to be a mid-trend provider?
The reality is FedEx lost its way and is now finding its way back on the path.
Well, what's your optimism on that? You're grinding it out in the conference calls and all that. Are you optimistic that they find their way back?
I am, and some of that I think it's going to be interesting who they pick as the new CFO. I think it's got to be an outsider. It's got to be someone who maybe is willing to make the tough decisions and making severe cuts to an organization that like I said earlier, maybe have gotten fat over the years, and so they are embarking on a restructuring of their ground and express network, which is something that they were very adamant that they were never going to do, and they finally capitulated and said we have to do it to be more competitive to a UPS. And we saw, Carol Tomé, the CEO of UPS, since she's had the helm of that company, and she's not an outsider, but she was on the board, but not a UPSer for life. She's done transformational things at that company.
Do you look at DHL as well? I mean, if I get afterthought address out of Paris, sometimes I get the package from France quicker than I do from Dallas, Texas. I don't get that. Is DHL killing it worldwide?
I mean, they are one of the leaders. We covered DHL too at Bloomberg Intelligence. They are another interesting company because they truly have their hands in a lot of the supply chain, whether it's contract logistics, freight forwarding, delivering mail in Germany, or delivering your packages from France.
Lee, thank you so much. Lee Klaskow with us, Bloomberg Intelligence. A brief on FedEx. I learned a lot there. I mean, FedEx was like a layup.
About where you order clothes from for your offspring.
Well, we have to put them in their garb, as they say.
Yeah, well, the Abramovich household perhaps was a little bit more tempered by the oil barrels in the living room, and someone suggested that they were coddled by protesting yesterday.
It's an interesting business, but I take your point yesterday that what Lee Klaskow covers is the foundation of the modern America. It's not like just trucks out of Arkansas moving chickens around. It's like logistics is a big deal.
I honestly think this is like The Graduate. What's the future? Not plastics, logistics. It's all logistics. I'm very much a logistics fan. I will say also, though, that this actually, the idea that people are not pushing back against price increases, this is a bit of a warning flag on a lot of levels.
There we go. We had to get the Bramo glue.
There you go.
FedEx. It's un-American. Futures flat. The VIX 13.74. What am I watching? 2's10 spread out near 100 basis points, 97 basis points with that elevated 2-year yield. Please stay with us. Another hour of Bloomberg surveillance. Chris Harvey, must listen.
On the next episode of The Circuit.
So yeah, here we are, Dolores Park.
I mean, you've been doing this like 15 years.
Yeah.
15 years. That's a long time.
This is a long time.
Does it ever
in
get
tech standards?
Does it ever get like lonely at the top?
Oh yeah. You can have all the money in the world, all the success in the world, but the thing that makes most people happy is just connections and relationships.
Watch The Circuit with Emily Chang Thursdays, 10 p.m. Eastern on Bloomberg Television, or 8 p.m. Eastern on Bloomberg.com or the Bloomberg app on connected TVs.
From the world of politics.
We're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power in the end.
Balance of Power. Live from Bloomberg's Washington headquarters.
We couldn't be more excited what's in store for you.
How long will it take? How many years? Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
Well, I think we're getting more.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Langs.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
that. Really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most.
This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure, with 2 more potentially to come.
I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority. Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people,
There's no question this industry is composed of some bad actors and some good actors.
the transactions,
Volumes have surpassed $24 billion per day.
and the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
From the world of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
Markets are fighting the Fed, as they've frankly been doing all year.
The U.S. economy is just a lot more resilient than what the Fed, what economists more broadly were ultimately giving it credit for.
It should have been a really clear signal. Forget about the chance of cutting this year.
Powell has a tough job. He's going to have to sell, yes, we can get inflation down, but without a major recession coming.
The only way that I can really see the central banks being able to have that smooth runway would be inflation coming down off its own accord.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on radio, on television. Farrow on assignment, permanent assignment. He'll be gone for, I don't know, is it like another day or two?
Another
or
week
something in the
after
week?
this week. He's going to be gone a couple weeks on a well-deserved vacation.
It's a British thing. I mean, Lisa and I haven't done this in 42 years. Farrow takes 2 weeks off every year. It's like, well, the Queen does or the King does, so I can.
They're correct, and we should too. That's
They're
all I
right,
have to say.
Farrow's right,
Exactly.
we're wrong. That's the banner.
That's a banner
Make
for
a
you.
banner for me, Amy, please. Farrow right, Bramo and Keene wrong. That's
Put
the
me
way it
first.
is right now. We've got an interesting day, more interesting than yesterday, and as we said in the last hour, yet by United Kingdom's stunning inflation. In this hour and in moments, we're going to explain the big tech boom. It really overwhelms every conversation in equities right now.
And perhaps distorts our understanding of whether the economy is slowing down or speeding up. If there is a lot of sections that are slowing down and AI and the tech boom overwhelms it, does it matter? Or can it keep chugging along because of what we see in terms of the promise of technological advancement?
Earnings season seems distant on big tech, and we'll do that at some point here in the coming weeks. We got the banks coming out, and I'm going to say the third week of July, maybe the second week of July. But the answer is this equity market continues. The levels 4434, SPX 34,300, Dow not near 16,000, NASDAQ 100, but we're it's up. It's been a huge year, and the VIX says it all. And the VIX goes to the volatility conundrum right now. Dean Kernert was brilliant yesterday with Paul Sweeney. 13.73 on the VIX is an oddity, to say the least.
July 14th, that is when JP Morgan kicks off the earnings season. Apple and the likes later in the month of July 28th will come out with some of those earnings. Your emphasis on that is an important one.
I think but we're going to do it right now with Chris Harvey. Let's get to it. Let's get to the brief, though. I think, Lisa, this is just a really important, it's the conversation right now.
Fed Chair Jay Powell, that is going to be the conversation later on this morning when he takes the helm over at the House panel. He's having a 2-day semi-annual monetary policy report trying to explain the hawkish pause. I keep going back to the hawkward moment that Peter Hooper coined. I think it's important to note that this has been a pretty muddied message saying we do think that we need to do more. Why not do it now? He's going to have to explain that at a time when core CPI is still very high relative to the goal of 2%, 5.3% in the U.S., and an upside surprise over in the U.K. this morning. We also hear from Austin Goolsbee around noon, 12:30 p.m.
He's going to have
Eastern.
a different story. I mean, Goolsbee, is distant from Bullard, I think we could say as a generalization.
He is on the dovish side, yes. Yeah. And that seems to be the tone of some of the new members as well. Fed governors Philip Jefferson among them, as well as Lisa Cook and Adriana Kugler. All of them, Adriana Kugler is currently U.S. representative to the World Bank. They're going ahead of a Senate Banking Committee to discuss their potential nomination, their potential confirmation on the board. Just to give you a sense, to your point, Philip Jefferson yesterday said that inflation has started to abate and that the U.S. banking system is sound and resilient. He's talking about the different polls here, yet tilting a little bit more on a measured rather than hawkish kind of approach. And today, President Biden is hosting Indian Prime Minister Narendra Modi at the White House at a time when a lot of people are looking to India as the driver of any kind of EM growth. That is where a lot of the tech companies, including Tesla, did you see this? Elon Musk planning a trip to India and talking about possibly
it just goes up, up, up. I mean, that's all there is to it. I mean, it's like on the edge of
Tesla or
it's
India?
No, Tesla. It's like a meme stock. I mean, I don't know. I don't own it. It's not in the triple leveraged all cash fund. That's what I know. We're going to get started here, folks. And for Global Wall Street, this is the high point of the day. Christopher Harvey. If you go to Bucknell University, the idea the chem majors are the nerds at Bucknell. Chris Harvey wasn't a chem major, but he was at Bucknell, which is like the Bucknell bubble. All you do is study finance with you because the winters are so cold. He joins us now, equity strategy at Wells Fargo. Your note, Chris, is absolutely brilliant about thinking back to 1998, 99, into 2000 and 2001 in the tech, the analog of looking back. What's the number one message in your study of this tech bubble versus that tech bubble?
So the number one issue is tech is not going to roll over. The major theme is not going to roll over until you crack the economy. That's what happened back in 99. That's like what's going to happen now. And I don't think you crack the economy until the Fed gets more aggressive. And so we'll have some wiggles. I think we'll have a pullback in the market. We'll have a pullback in big tech. But that overall theme is still in place. And not until the economy breaks do we really think about that trend breaking.
Is tech a set of individual companies that you study at Wells Fargo, or is it this amorphous sector blob up there like a 1950s sci-fi movie?
We do study tech. We do study individual companies. But what we do is we focus in on a lot on the Uber, what we call the Uber cap, or the top 50 names. You can look at one or two names, and that's great, but that doesn't give you a trend. And we look at the Uber caps because as you go across capitalization, small cap, mid cap, large cap, they all have characteristics. And the Uber caps are the ones that really have that AI exposure, that tech exposure. And again, going back to 1999, that's one of the things that we did see. We saw that Uber cap outperformance, we saw that tech outperformance, and before all that, we saw the economy and the old economy stocks roll over.
You said something I want to pick up on. You don't crack the economy until the Fed gets more aggressive.
Right.
Are you saying the Fed hasn't gotten aggressive?
Lisa, the Fed has gotten aggressive, but I think we can all agree that the economy is a lot less interest rate sensitive than we thought. The way we're characterizing the economy is an economic malaise. We did think we thought the probability of recession spiked with the banking crisis, but now we think that's come back down. And so we're really looking at an economic malaise more or less than a recession on the horizon, right? The consumer is still okay, still has cash on the balance sheet, eating through their savings, but still has savings. Corporations still have plenty of savings. Balance sheets are much better. And so really you need some sort of shock to get us into a recession, or you need a lot more time. This is taking a lot longer than we expect, and I think it will take a lot longer than we expect.
Do you think that the amount that people are willing to pay for goods will come down, that there will start to be some consumer pushback at a time when we just heard FedEx, yes, you're seeing volumes down, but they're still increasing prices more than expected, and that is a theme across a lot of different industries.
Yeah. So I may go off on a little bit of a tangent. If I do, just pull me back in, because I talk about
surveillance.
Don't worry, it'll happen. Carry on.
So I talk about the consumer a lot. And if you think about the U.S. consumer has been buying, and I'll exaggerate a little bit, since he or she was 5 years old, right? It's a very savvy consumer. We've been spending a lot of money. We know when there's utility. And what I'm seeing is the U.S. consumer has been pulling back. They've been pulling back on goods. They're not finding a lot of utility there. If you look at real retail sales, if you look at retail sales in general, it's not as strong as you would have expected. You are seeing, if you go to the Walmarts and the Targets, you are seeing a trade down. The U.S. consumer's behavior has changed, and I think the U.S. consumer is a lot more savvy than we give he or she credit for.
Going forward then, do you think we have seen this rolling recession in certain areas that offset something that's deeper than an economic malaise? Regardless of what the Fed does, they are cracking certain segments of the economy and others continue to chug along because of different advancements and less interest rate sensitivity.
You really hit on a great point, and this is something we talk about in the office a lot. You can't paint this economy with one brush, and you are seeing kind of a it's a very heterogeneous economy and market. You're seeing certain sectors that have already rolled over and are beginning to improve. You're seeing other sectors that are beginning to roll over for the first time in a while. And so one of the things that's causing this to be an economic malaise is there's not, it's not synchronous, right? The economy is very, very, if you look at the housing market, the new issue market, or the new market is very strong, but the old one is 3 and 30. I'm not going to leave my house because I have a 30-year mortgage at 3%. Very different. If you look at some of the construction spending, manufacturing, warehousing, it's through the roof, but other parts of housing and construction are beginning to roll over. So again, I think you hit on a very important point, and it's something that we really have been diving into, and it's hard to kind of disentangle. But this economy is not, it's not really synced up, and you cannot paint it with one brush, which is why the economy has been a lot more durable than a lot of people have expected.
It's been a huge theme of the program. This lack of aggregation right now is tangible. I want to point out one thing. You can do this off the Bloomberg, folks, the Bloomberg terminal, the description screen, DES. JP Morgan is owned by institutional 75%. Apple is owned 61%. I know you don't want to talk individual securities here, but, you know, woe is me, big tech to the moon. We're all going to die. Except, can I make the statement big tech is under-owned by institutions?
I would agree with that 100%. And what I would say is we do a lot of positioning work. And in our positioning work, what we've seen for years is the buy-side community is underweight tech, but it's mainly underweight Apple and Microsoft. We were talking about this in the office 5 years ago, kind of a flip title, but we entitled it Return of the Mac. And what we had seen back 5 years ago is a very big underweight, an exceptional underweight in Apple. That's never closed. And what we're seeing is one of the things that's giving us pause, and I think one of the things that's pushing the market is this underweight in Uber caps in Apple and Microsoft and a few of the others. So I would agree with you what you're saying is the institutions are much more underweight.
Bramo, John from Italy emails in and he says, get a new SPX quote from Chris Harvey here. 4,200, can you lift it up? Come on, I gotta make some news.
So, Tom, here's what I say. So our year-end
target till late, but hey, no one's watching. Go.
So our year-end price target is 4,200. At the end of last year, we also had a soft landing target. That was 4,400. Right? We cannot.
The two targets.
And it's also the x-axis.
Do you have a Hawkwood target? If we get a Hawkwood Fed, can you give? Come on, you got to give me 4,500 this morning.
No, I can't give you 4,500. But this is why we go back to it's about the economy, because I can make certain adjustments, I can change my estimates, but really, do I have a lot of confidence in that? No. But what I have a lot of confidence in is it's really about the economy. The major trend's not going to break until the economy breaks.
Chris Harvey, Wells Fargo. Can't say enough about it. We protect the copyright of all of our guests. Get this really interesting analog study from Wells Fargo here, looking back to the late 1990s, I should say. Futures at -2. Dow futures -20 on the SPX percent. Well, we're fractional. We're down 0.5%. We say good morning.
If you're just joining the program, we are taking a look at what we're expecting to hear from Fed Chair Jay Powell. And I just keep thinking about what Chris Harvey said, Tom, about the economic malaise until the Fed goes full hawk. Essentially, that's the idea, is that unless they get much more aggressive, you're going to have this bifurcated push-pull of all the different industries at different speeds that create a resilience that really has defied a lot of expectations.
I think it's really, really important idea, and I'm going to go back. I'm so sorry I can't cite who it was in the blur yesterday, but someone said it. It may have been Mohamed Al-Arian. I can't remember. The basic idea is this is a Fed that recently has been successful. You see that in the stock market, in that they moved up, lots of criticism, including from Dr. Al-Arian, but recently they're honing the message while they figure out how to go higher. I'm not saying I agree with that, but that's sort of a zeitgeist out there that the Fed You see, I get, you can't, I mean, the wide camera here does show you sometimes the Bremel angst that's out there.
Well, I just don't know that there's any clarity
You don't treat
whatsoever
Pharaoh
from
this way.
there. I do. I think that there's no real clarity right now with what we're getting from the Fed and the messaging. They don't know what they're doing.
There's
They're
single
just pushing it
There's a
through.
single clarity, and Chris Harvey addresses crystal clear. There's no recession. We got wrong the gloom call.
There's a recession in certain pockets of the economy. This is the sort of strange aspect of the market right now, is that if you go to certain sectors, think about all the white-collar workers that have gotten laid off from certain select slices.
You know, the last time we had a domestic like this, we were in Fairway in the vegetable section, arguing about the carrots.
Yeah, you wanted the ones that just look terrible.
Well, I did. I wanted the cheap carrots, and you're like, they got to have green on them and be grown up the Hudson River Valley.
Absolutely the opposite. That's all I could say.
She's looking at the carrots, the Schenker Farm carrots. We got to buy them at $4 a pound. Stay with us. A domestic.
This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month. Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
It's clear Russia must pay for the destruction that they've inflicted. So we're working with allies to explore lawful routes to use Russian assets. And on Monday, we published new legislation to allow us to keep sanctions in place until Russia pays up.
The Prime Minister of the United Kingdom, Mr. Sunak, a very busy moment for him, no doubt focused on what the Bank of England's doing with his core inflation surging. What did you say, Lisa, earlier? It's like 31 years back?
31 years has been this high, 7.1% at a time when it was supposed to be falling, and that is core inflation stripping out energy and food.
Interesting to see, to say the least. The Prime Minister, of course, talking there on Ukraine and on the challenges forward. A quick data check: futures -4, Dow futures -29. Yields up and elevated, up 3 basis points as well. We need to make note of that, 3.75%. We're not on the 4% watch. They're on the 6% watch in the United Kingdom, aren't they?
Well, some people pushing that idea back. At the same time, what can they do to really kill this? Given the fact that Neil Shearing was saying it's almost a certainty that they're heading into recession, it's just whether the central bank can mitigate it on some level.
Sterling 127.14 as well. One of the most painful meetings I've ever gone to with Bloomberg over many, many decades was at Columbia University a zillion years ago, and it was an Afghanistan reconstruction conference. And it was really painful in the midst of a horrific war. We're doing that again. We're doing it in London with the Ukraine Reconstruction or Recovery Conference, I should say, a Ukraine Recovery Conference. Maria Tadeo tomorrow has a key interview on this with a leading authority. We'll mention this at the end of our discussion. But right now, on the hope of Ukraine recovery, Maria, I don't get it. We're at war in Ukraine. Why are we recovering in London?
Well, that is a key question, Tom, and this already started a year ago. Remember, this was an idea that came up from the Swiss, who said, it's great to help Ukraine when the war is going on, but we have to figure out the future and the reconstruction efforts. And it is a very fair question, why focus on the future when you still don't have peace? But Tom, the reality is, the reason for it is the numbers. They are enormous. And today we have the World Bank saying that Ukraine will need, and this is, again, a very big number, $300 billion over the next 10 years as a result of that war. And just to put it in context, Tom, that is 3 times the GDP of Ukraine. So this conference is about, well, making sure you have money, funding, and this constant supply of money. And just very briefly, because this is happening as we speak, we have another pledge from the United Kingdom, which say they will pay $3 billion for Ukraine. Another pledge from the United States, an extra $1.3 billion, but also the European Union saying we will provide 50 billion euros over the next 4 years. So that shows you the magnitude of the task at hand, really. It's enormous.
The day of the invasion, late February, I think it was now 2 years ago, I can't remember, David Folkert's Landau of Deutsche Bank was absolutely brilliant on the fiscal stimulus, the government impulse to come. You more than anyone I know, Maria, own this. Are we seeing a general fiscal stimulus across an austere Europe right now? Forget about the recovery.
Look, and I remember that night very well because it was that night where European leaders were meeting in Brussels and they decided they had to go for big sanctions and then crossed every line. Remember the energy. No one thought they would sanction Russian energy. They've done it now. In fact, now they talk about maintaining those sanctions. And also a key point, Tom, it's what to do with the Russian frozen assets. We talked about this at the Munich Security Conference. Remember, this is the key point. Who is going to pay for this reconstruction? When it comes to the fiscal space in Europe, the problem that they have is inflation. So on the one hand, yes, headline inflation has gone down, but core inflation is sticky. So they have to appeal to voters. But you also have the ECB and the IMF saying, well, you have to rein in some of that fiscal space. And on top of that, they're now negotiating some of the new rules that should enter in force from next year. So as you know, the fiscal story is always very political in Europe. It's not just about the fiscal space.
Especially at a time when Ukraine will be looking for money, not only to rebuild the nation, first they have to win and end the conflict. Will we get some sort of update on what progress they're making right now versus Russia, how the nature of the battle has changed as the conflict grinds on?
Yes, and look, when it comes to this counteroffensive, they are very secretive, and we can understand why. We know that when it comes to defending themselves, Ukraine has become very efficient. We know their air defense is now very efficient, but what allies want to see is progress on the battlefield, to see that Ukraine can claim back some of that land. And they know that this is key, because if you want that constant support, you need to show you have the upper hand when it comes to the battlefield. The other key point for Ukraine, and this will be the crucial issue when NATO meets next month, is what is the path for this country when it comes to NATO. We talk about the future of Ukraine and the security guarantees for Ukraine, but what about NATO? And that has not gone away. That is really the centerpiece now of diplomacy happening in London today.
What's the nature of the conversations, Maria, that you're having, talking about once the conflict is done, before it's done, talking about lining up business opportunities, lining up reconstruction to try to fuel growth and potentially rebuilding? How much can people really double down on hypotheticals at a time of so many uncertainties?
Look, incredibly difficult, and a lot of this, remember, is pegged to Ukraine joining the European Union. They have said they want to become a member, and Ursula von der Leyen, who was very smart on this, got on the train to Ukraine and gave them that survey to potentially become a member state of the EU. But we know that takes years for companies. What they want to see is insurance. How can you do business in a country at war? That is also very difficult, and they want clarity on the Russian frozen assets. This is an incredible story. It's never been done to this extent, to confiscate a central bank. Can it be done? That's something they want clarity to do.
Maria, I've got to digress here. My read of the weekend was Gideon Rockman in the Financial Times with a spectacular article on how, an essay, if you will, on how Europe is falling behind. His data on relative GDP dynamics to the United States was just jaw-dropping. Within your purview from Brussels, Is Europe still within eurosclerosis? Is Rockman identified?
There is a lot of, I'm not sure if panic is a right word, but there are certainly fears about the implications of the energy crisis and the medium-term damage that it has done to the European industry.
Yeah.
When I talk to European officials here, they say, if you don't have an industry, you do not have a country, you do not have a continent. Emmanuel Macron would probably agree to that. And yesterday, Ursula von der Leyen also appealed to that with a new strategy for the European Union, which she says will focus on three things: promoting Made in Europe, protecting Made in Europe, but also finding new trading partners for Made in Europe.
Maria Tadeo, thank you so much for all your work on the continent of Europe. Ms. Tadeo will join us tomorrow, 8:30. This is an exceptionally important interview, maybe less about Ukrainian recovery and more Ukrainian reality. Dennis Schmill at 8:30 hour tomorrow, the Ukraine Prime Minister. Looking forward to that, to say at the least. The thing I did at Colombia and Afghanistan, it was with Jeff Sachs and the giant Ned Phelps, and it was just so difficult to see well-meaning people talking about recovery in the middle of a war. I just think it was really, really difficult.
About 6 months ago, I was in Europe and I was having conversations with a number of business leaders about the road forward and what they're looking for. And the one unspoken reality that they all are thinking about behind the scenes, could the recovery of Ukraine, the rebuilding of Ukraine, give that extra boost of growth to Europe, kind of like the post-war reality of the U.S.? And that is something where people actually start the fiscal spending. It is an awkward conversation to be having, as you say, amidst an incredibly painful, ongoing and deepening conflict in many ways. And yet here we have an entire conference around it where people are trying to game out exactly how to do that. Fascinating moment.
It's a character of austerity, and I don't mean that in a negative way, but just a cultural statement of what we want to do on the balance sheet. And if you have a shock like a war, somebody's got to pony up the money for reconstruction. You talk about Ukraine recovery, the pipeline that's in the Baltic Sea that's under huge debate. I mean, there's another infrastructure project, to say the least. What about a Russian recovery after Putin? Whatever happens to Mr. Putin, how do you help Russia in a post-Putin sense recover if that's what's going to happen? I
haven't heard anyone discuss it.
No, it hasn't come up, and it involves billions and billions of dollars. We're going to look at the market right now. We see it was sterling 127.20 off this inflation shock today, and the euro 109.19. Dollar stasis is really what we've had over the last number of days, with DXY 102.59. The two-year yield 4.71%, further curve inversion. Coming up next, Amanda Lynham, BlackRock. This is Bloomberg. Good morning.
you're so intimately linked to the future of the UK. What are you seeing when you go to branches and in the country?
Yeah, we're seeing a lot of anxiety at the moment. I think the recovery from the pandemic has been and is continuing to be very strong. So I think we're seeing the economy recover. But with rising interest rates, with inflation, those are things that peoples and families and businesses haven't had to deal with for 10 years. So a lot of business owners today haven't had to operate in that environment. So it's causing quite a lot of anxiety, which means for us, because we're up and down the country in branches and offices, we can spend a lot of time talking to businesses and helping them plan and deal with it. But it is, it's very different, and it's not something people have had to operate in for a long time.
Our studios in New York and San Francisco, our expert hosts of the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television, your global business authority.
Bloomberg Surveillance on radio and television. John Farrow, Lisa Bramwitz, and Tom Keene. Mr. Farrow on assignment, I think through the end of this week. Maybe he's back Friday. We'll have to see.
No, he's out until through next week.
He talked
as
to
well.
you. He didn't talk to me. It doesn't tell me anything. Futures -4, Dow futures -24. Big deal. We really haven't talked about this. The VIX 13.74. And I get it. We're buttressed up near recent recovery highs off the October low. But Lisa, there's all these oddities going on. I mean, I don't get it. I had to talk to Dean Kernet yesterday, and even when he talked, I was confused.
People talking about the options market being a bit skewed and ways to play it, and people basically not wanting to necessarily add to their exposure or take back, but they're playing it in the options market, creating some strange diversification of views. The really stasis this morning in the dollar.
Summer here, lots of kurtosis. That's the answer. There's lots of kurtosis. With that, we'll save the data check here. Seriously, we're looking at curve inversion, the 210 spread, all the radar up on this 97 basis points, ever so much wider. A revisit to 100 basis points would be a big deal. We're looking at movers now, and after Lee Klaskow, I learned a lot about FedEx from Mr. Klaskow.
To me, the big takeaway is that they're able to raise prices on consumers. Their volumes, though, are dropping, and you're seeing that across the board for all of the shipping and logistics companies. That today they're all suffering the consequences of below expected 2024 profit outlook by FedEx. Those shares lower by 2.7%, retracing a loss that at one point was down about 7% in after hours yesterday after they reported earnings. To me, though, just to highlight this, they benefited from higher revenue per package and cost reduction actions. If this represents the economy, this means that they're able to raise prices and they're cutting jobs. The sort of stagflationary environment that you're seeing in certain sectors of the economy. And Tom, the Keen Cam is picking up some skepticism from you.
My skepticism is this place I go, they have a Greek salad, and I don't get it with any add-ons. I can't afford it. But anyways, they got the Greek salad, and all I know is in the last 3 years, the Greek salad's gotten smaller.
Shrinkflation.
Fact.
Yeah, shrinkflation, which is something that keeps going. I also want to bring up Tesla. And you see those shares rallying. This comes after already 35% gains on Tesla just in June. That builds on the 24% advance that we saw in May. Today, perhaps the catalyst is Elon Musk meeting with Narendra Modi of India, talking about possibly building some sort of factory there.
Come on, it's at 80 times earnings. Forward PE, trading at a 10 times valuation of Generous Motors.
Barclays came out and they said that the shares have rallied a bit too much and too quickly, and saying that it's essentially becoming a thematic stock due to artificial intelligence and excitement around the charging. Barclays. Grumble, grumble.
Grumble, grumble.
Grumble, grumble. Yeah. Why grumbling?
I don't know what to make of it. You know, I just don't buy the whole all-in jump-in AI story, but I don't know what to make of it right now.
To me, the bigger story with
Tesla.
Tesla.
When Farrell gets back.
To me, the bigger story with Tesla was that if they create the charging networks for electric vehicles for GM and Ford and who knows who's next, that's a game changer because suddenly this isn't an auto manufacturer. This is something else with a steady stream of revenue from even essentially other auto manufacturers. That perhaps is what's turbocharged.
Yeah, Intel quickly here to sell a division. It's a $4 billion transaction. I guess this goes out to Bain and it really talks about I mean, it's IMS, but it's really, I love this, it's nanotechnology. IMS and Nanofabrica. The last AI was nano. We're going nano.
The nano versus the macro.
Nano.
And this has been the real tension of the day as we talk about some of these developments that have bolstered areas of the stock market and the economy, even as you do see a Neil Shearing downturn in other sectors. Amanda Lynham of BlackRock calling the Fed's pause a hawkish skip. A lot of people have been talking about that for the need to curtail inflation, saying last week's FOMC meeting solidified our expectations for a higher for longer interest rate environment. But for corporate credit investors, the pace of additional rate hikes is less important than the length of time this higher cost of capital environment persists. It's an important point, especially as Chris Harvey says, unless the Fed goes full hawk, we're not going to see anything other than an economic malaise. Does full hawk mean an x-axis that goes for a very long time? Amanda Lynham, head of macro credit research at BlackRock, joining us now. Amanda, how much more restrictive do 5% rates get as time goes on?
Oh, thank you, Lisa and Tom, for having me. Good morning. Look, I think it's a challenging environment for a large subset of the corporate credit universe, specifically the subset that has a large exposure to floating rate debt. And, right now we've already seen, as you well know, the all-in cost of debt for the leveraged loan universe double, more than double actually, since the first quarter of 2022. And the signaling that we've received from central banks, both the Fed and the ECB, is that there's probably more room to run there, and President Lagarde was very clear on that in her press conference recently. So I think that there's more upward pressure, but as you noted at the start, I think whether we get an extra 25 or 50 basis points from here is probably less relevant than the amount of time that we stay in this kind of higher cost of capital environment, because corporates are looking at these upcoming maturity walls, which yes, they are in mostly 2025, but that will need to be addressed sooner rather than later. And for those corporates, we're not really expecting any sort of relief, certainly not in the form of rate cuts. And I think actually, if you look at where the all-in yields are in a lot of the subsets of the corporate credit market, the risk-free rate has done a lot of that heavy lifting, and spreads are fairly contained. And so there's probably some room for spreads even to move higher.
There's a lot of mathematics there. You get that from Amanda Lynham. Amanda, let me cut to the chase. Finally, we have a risk-free rate. William Sharp is happy. We got a risk-free rate, and then you got spreads up, and Lisa's pointed out how narrow spreads are. What are the ramifications if the actual yield in the aggregate corporate space widens out? What actually happens to our listeners and viewers?
I think the first order implication is that you see an uptick in financial distress. And you're already seeing that in the default rates. For example, in the US market, the leveraged loan default rate is outpacing the high yield bond default rate by the largest magnitude since the data on the Moody's series that we use began in 1996. And realistically, over the past 2 decades, there have been very few instances where the loan default rate is outpacing the high yield bond default rate. And I think really that speaks to the point that you're raising. It's that real-time marking to market of the higher cost of capital in the loan market as the policy rate has moved higher, borrowing costs for floating rate debt, if they're unhedged, have moved higher in tandem, and that's causing stress for a subset of smaller issuers that don't have the pricing power, they don't have the financial flexibility, perhaps they don't have the refinancing options, and so they're at a disadvantage. Now, that's not a common subset throughout the vast majority of the market, but for the smaller issuers, that will be stressed.
Is commercial real estate either actual or securitized? Is commercial real estate an opportunity or just a massive wait for the washout?
The way that we're viewing it is another reason for banks to be more selective in lending. So as you know, it's a more than $5.5 trillion market. Banks, both small and large, own roughly half of that. And I think it will take some time for the price discovery process to play through. You know, it's reasonable to think that metrics that we used in past cycles, like LTVs, like cap rates, may not be as relevant in this cycle, given the significant change in prices that we've seen, and also given the interest rate volatility. And so I think it will take some time for investors to get clarity on the macro, which determines the cash flows of those assets, and then also to figure out where the real bottom exists in price discovery. That's probably going to take longer to play out than, for example, the stresses that we might see in the corporate credit market among those smaller issuers. But it's something that we're definitely watching because it's so interest rate sensitive. I think the real point, though, Tom, is that just like commercial real estate can't be painted with a broad brush, all CRE is not created equal. You know, office, we think, is perhaps the most vulnerable. Similarly, in the corporate credit market, quality means much more than ratings. It's really nuanced. It means pricing power, refinancing options, business model resilience. And those are really things that I think will be increasingly important in the second half of the year, because the fact of the matter is that we didn't make as much progress on taming inflation as we liked. There's probably upside risk to policy rates, a higher cost of capital environment, and so we need to tread carefully when we think about what companies and sectors and asset classes are best positioned for that environment.
And the upside risk to policy rates is what people are focused on when they listen to Fed Chair Jay Powell as he takes the seat on Capitol Hill in about 2.5 hours. From your vantage point, you say it's more important how long rates remain high. When does it start to bite the most? One of the maturity walls, the most painful, and you start to see the interest rate sensitivity really come to the fore.
Yeah, so we've seen some early signs of that in the default rate, but I would say at current levels, the default rate is still pretty well contained relative to the history. There's probably some upside risk to that. I think when the 2025 maturity walls really become an issue is 12 months prior to those bond maturities, because for a host of reasons, we know that high yield corporates in particular don't like to let their maturities become current on their balance sheet, because that has implications for the year-end audit and going concern language. And so even though 2025 seems far off in the distance, it's actually not that far off if you think that corporates will start to address that in 2024. One really interesting point, and I don't think that this favorable technical will persist, the magnitude of high yield supply and the purpose of high yield supply has been incredibly bondholder friendly so far year to date. It's kind of the best of both worlds. We haven't had a lot of high yield supply, and the supply that we've had has been used for bondholder friendly needs like refinancing and debt repayment. As we get closer to those maturity walls, that volume of supply likely picks up. And so that favorable technical that's probably been an anchor for high yield spreads, frankly, year to date, will probably ease up a bit. And so that's something certainly to watch as we get closer to those maturity walls. But yes, Lisa, to your point, I mean, the length of time and the willingness, as you alluded to earlier in the program, for the Fed to really stay the course and keep rates in restrictive territory or even move them higher is really the key consideration for corporate credit quality.
Amanda, thank you. Amanda Lynham with us with BlackRock this morning. Lisa, what'd you learn there? That's your world. My head's spinning over all these dynamics. You've said the spread's narrow, price up, yield down for corporate paper, and she's suggesting that may reverse.
You put together the ideas of this economy being less interest rate sensitive than a lot of people had expected. That's what Chris Harvey was saying of Wells Fargo. And then you say, okay, well, if you hold rates this high for a year, 2 years, all of those companies that have hunkered down and not borrowed money, all of a sudden borrowing money at those higher coupons that they have to pay, that changes the dynamic. And that, I think, is really important, that it's not just how high those rates go, it's also just for how long and how much that really does pressure some of these companies.
Well, the longer it's there, and of course we've seen that with the Fed, to say the least. The S&P, a fractional -0.1%.
Just joining this program, I do have to say that the Mashiasa son, the CEO of SoftBank, kind of making a sort of about.
We will step lightly here.
Yes. Well, I mean, basically all in on their novelty fund, investing in all of the tech darlings, got absolutely decimated, and now changed tone.
I'm gonna put it in someone else's words. I'll give it to Robert Smith over at the Financial Times, and he said there was a whole tongue-in-cheek thing here. The headline from the FT, and this is on, of course, SoftBank and the disaster that was. I think with Bloomberg reporting, I can say it's been a disaster. Masayoshi-san says SoftBank ready to go on, quote, counter-offensive. The billionaire chief, after talking to Bramo, talks up AI and reveals, when he questioned his achievements as an entrepreneur. Okay. Wow, is this like history reduxing?
So this is a quote from this Financial Times story. Masayoshi Son saying, "We have done enough being on the defensive. I feel the timing for us to go on the counteroffensive is soon. I'm very excited." Here's the issue. Is this an AI-driven jump-on-the-boat kind of enthusiasm? Is this an opportunity that he sees to invest in some of the startups that might not be getting financing through other avenues due to a more restrictive financial policy, monetary policy? We've seen this before.
And again, it goes back to the AI thing, and we're trying like crazy not to put our input into it, but I think it's something we can't avoid. In July, we're going to have to talk about artificial intelligence more.
I got a ChatGPT message from my brother yesterday.
Oh, did you?
Yeah, he wrote a poem to me.
Those.
Yeah, it was touching.
It was touching. ChatGPT. This is important. Coming up, Jimmy Ramady will join us, the former CEO of IBM. She has a wonderful book out.
Did art conservation help you in any way to be a better investor? And should a lot of good investors learn how to be an art conservator as well, or not?
I think in conservation and art history and liberal arts, I think differently than a lot of people that have just done finance. And also, I think I mentioned one of the things is to do conservation, you have to really do a lot of pre-work before you actually do a treatment. And so a lot of that pre-work is very similar to what I do in due diligence for investments. Lots of testing, lots of thinking about what could go wrong, lots of research. When I was an art historian, that was in the old days before the internet, but you'd sit in the stacks and you'd pull one thing in a bibliography on this and you'd sort of like a mosaic theory, put all these things together. I feel like I do that in my due diligence.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals. Fixed income fix. Watch Bloomberg Real Yield every Friday at 1 p.m. Eastern, right here on Bloomberg, your global business authority.
The opportunity for productivity improvement across the S&P 500 and broader equity economic landscape here in the U.S., we think is going to get really interesting here. So longer term, we're pretty comfortable the market can hold a higher valuation, courtesy of mega cap growth and tech, but also because the rest of the market is going to prove out that it's less cyclical than historically perceived.
Scott Cronert, Citigroup, thanks to Zero Hedge for writing up that conversation yesterday with important comments from Mr. Cronert on the market forward. A lot of value there. And Lisa, I thought Chris Harvey earlier with Wells Fargo was something about just forget about the 1990s analog.
That until the economy cracks, you can see the same kind of melt up, and that's certainly what we've seen so far.
We're going to get right to it this morning as we do. Futures flat, the VIX 13.72. I'm not quite sure how to introduce this, but I'll make a go of it. There is a movie. It is called Northside 777. It is of a Chicago long ago. Jimmy Stewart takes the lens and is fabulous in that movie until halfway through, you realize there's an old lady on her knees at the Wrigley Building taking the movie, stealing the movie from Jimmy Stewart. And of course, that is the iconic grandmother and mother within called Northside 77. This is an extraordinary book. I really don't know what to say. Ginny Rometty, as you know, it's the most mispronounced name in corporate world. Ginny Rometty with us this morning on a hugely courageous book. And I want to start with the blistering first 50 pages of your childhood. And Baba came to the rescue. Who was Baba?
My great-grandmother. And you're right. And you speak of the Wrigley Building because I was raised by really strong women who all suffered great tragedies. And that was my great-grandmother, who came here from Belarus, the last person alive from her family, who worked third shift in the Wrigley Building cleaning bathrooms, never spoke a stitch of English, and saved every dime in U.S. savings bonds. And one day it would allow us to have a car.
What was the first day like at Northwestern? There were fancy people from New Trier, debutantes from New Trier.
Yes, you know that area. And there I was. Yes, there I was. No, I was there by the grace of God, right? Just lucky enough to get a scholarship. And what I remember is having gone to the store and bought one pair of jeans and topsiders to try to fit in.
Did you use a slide rule?
I did use a slide rule. You're dating me now.
This is like a nerd fest.
Yes.
Let's go to the woman from Chicago who wouldn't know a slide rule if it hit her over the head.
From a slide rule to today, it's actually an appropriate kind of pathway at a time when tech is at the epicenter of how to get from the slide rule to the graphing calculator and beyond, right? How much can you see some of the lessons that you learned at the helm of IBM of how to bring a company up to speed with technology that moves more quickly than anyone could imagine?
Yeah, it's timely, because even though the book took me 2 years to write, Good Power, there's a whole section in it on AI. Because a decade ago, I spent quite a bit of time trying to bring AI into the world to solve really tough problems, and here we are now. And to me, the things I learned, everybody wants to talk about the technology. This is going to be a people and a trust problem. That is what I learned from all these years, in that, you know, with something like AI, I see it as two sides of one coin. And if we don't manage the good and the bad at the same time, we're going to have trouble.
When you look back on your legacy at IBM and you think about some of the advancements that perhaps were shrugged off at the outset, whether it was cloud computing or some of the others, what would you do differently, or how do you understand what to identify as something that holds promise versus the next, false hope that everyone's going to cling to?
Yeah. Look, I think this is difficult. It's difficult because actually many of the bets we placed were correct. Some timing was not exactly right on those. But today, everything we did around AI and now it's hybrid cloud is what the company is really growing from. So the idea when you run a company, and IBM's the oldest tech company, and clearly I had to lead it through its most tumultuous reinvention, is that you've just got to make those decisions for the long term, even if you may not see them play out during your tenure.
For joining us on radio and television, Good Power. I can't say enough about it. It's summer read thin. This is great, but very dense. 230 pages here on a life story that's extraordinary, and also the realities of IBM. I'm going to address it. You've had critics like a piñata here on the transformation of I've Been Moved. I want to get to Gerstner in a minute, but the way you used to read the statement from Sam Palmisano is you looked at the free cash flow on page 2 of the annual report and you said IBM to the moon. What happened? How did Palmisano get this so wrong?
Look, I mean, what we had done very well to a certain point, but then the world changed.
The world changed.
There was not just one tech trend. There was cloud, there was data, there was AI, mobility, social media. And that's 5 trends, not one.
In the meetings, did you blame McKinsey? Did you bring in consultants who screwed this up? Why did you have such an inertial force where you couldn't change faster?
Yeah, I think what you always have when you're an incumbent in something, it is both you're trying to protect, not just protect the past, you've got customers that you've got to serve, yet you've got to move to the future at the same time. And so that really, I said, every one of us had a challenge, and mine was to now prepare a whole new technology portfolio for the future. But I had a double sort of challenge in that I also had to reskill the workforce. And so when I began, folks weren't prepared for future skills.
At the late in the book, you're phenomenal on this. You go to Brian Moynihan at Bank of America, who's an animal. I mean, I love, Brian, you go, what's the Fed going to do? Baloney. He's a bank animal. He knows the deposit flows in Kansas City. And he talks about hiring for skill.
Yeah.
Does that mean you only hire engineers?
Yeah, look, this is something that I work passionately on now, this idea to hire for people for their skills, not just their degrees. I came to it having had a mother. I was abandoned as a kid, and my mother had no education. But I quickly saw access and aptitude were not equal, meaning she had aptitude, no access to education. So she got a little bit of education and can get an hourly job, a little more, a little better job to get us off of things like food stamps. Fast forward, I would be searching for people like cyber. They're not in the marketplace in 2012. We'd start to work with community colleges and high schools, and I'd say, why aren't we hiring these people? They can do the job. Well, 100% of our requirements are college degrees. And it would lead me down this path for really now almost 2 decades of a movement. I think it's essential to democracy in this country that we revisit, having found 50% of our jobs were over-credentialed, requiring a degree to start when you didn't need one to start. This idea that where you start shouldn't determine where you end. That's skills first.
You're joining the show at a really important point, and you're an important voice at a time where we talk so much about tech and how much that's a divergent story from the rest of the economy. Do you think that the big tech names that have really become the behemoths are doing a good job managing the technological trends, managing to train people in the appropriate ways, and creating a path for a longer type of trajectory?
Let me answer that 2 ways. One is there's a whole chapter of what I call stewarding good tech, and it isn't just the tech companies. It's now all of us, and as much effort's got to be put on preparing people to see a better future because of this technology. I mean, my biggest learning with trying to roll out AI, particularly with professional people, they don't trust it. Unless they're part of its co-creation and how it's used, won't use it. So as you go forward now, this is about reskilling not just your current workers. You know, it's going to be multiple times in our lifetime. Once and done education is over now. And so that idea that I think the side of the coin about preparing the workforce is totally not paid attention to right now. And to me, that is the biggest thing. And second is really getting people to trust the technology. You know, I had a lot of experience with a big company with a big brand. And when you introduce AI, there's very little tolerance for it to be wrong when you're a big company. A startup, no problem. But when you start using it for health, financial services, you're in a whole different ballgame with how people react to it. So that issue of trust and preparing people are what I think is not being acted on enough.
I'm out of time, but I got to squeeze this in. I got 14 more questions. I got time for one question. What was the best practice of Lou Gerstner?
I have immense respect for Lou, and to this day is a very good friend of mine. I think he was a brilliant both strategist and execution leader, both sides of the coin.
He got his hands dirty, as you say.
Absolutely, and to this day.
This is like gospel to me.
Yes, absolutely. You and I share
do
that.
nothing on the show. Everybody puts it together for me. I just show up.
We share that admiration. He is able to simplify the complex in an amazing way.
This is a great book, Good Power, Leading Positive Change in Our Lives, Work, and World. The first 50 pages is blistering. There's no other way to put it. Ginny, I'm not going to pronounce your last name.
That's all right.
Rometty.
Rometty.
There you go. Got
Nailed it.
Nailed it. You pronounce it 4 different ways and hope one of them is correct.
Ginny Rometty joins us. Good Power here this morning. Futures -3, Dow futures -19. Lisa, this book, I mean, you look at how she got to Northwestern is just part of it. It was
the
a little
American
different.
dream. This is the classic American dream.
Then there was a nightmare of IBM. We won't talk about that. We'll save that for the next interview as well. Futures -3, Dow futures -19, the VIX 13.71. Stay with us on radio and television. This is Bloomberg Surveillance.
New York City, a $100,000 salary feels like just $36,000. That's according to a new study that looks at 76 of the largest U.S. cities to see where $100,000 goes the furthest, after taxes and after accounting for the cost of living. For many, reaching a six-figure salary is a huge moment when you feel like you finally made it. But that feeling may not last long when you realize just how much taxes and the cost of living in an expensive city takes out of your paycheck. And that's especially true after 2 years of inflation. Hybrid and remote work have opened up so many more opportunities for people to choose where they live. So that forces the question, should I stick it out in an expensive city or try to find somewhere more affordable? So where should you live if you want to maximize your salary? Consider Memphis, Tennessee. The home of the Blues topped the list with a take-home pay of about $86,000. Tennessee doesn't have an income tax, and the cost of living there is about 14% cheaper than the national average. So $1 there takes you much further. Texas is another popular choice, and it's clear why. 7 of the top 10 cities where $100,000 goes the furthest are in Texas, a state known for low taxes. Of course, there are so many factors that influence where you choose to live. You may want to be at the center of things, or be near family, or be somewhere where there are a lot of career opportunities in your field. It's not always just about dollars and cents.
On the next episode of The Circuit.
So yeah, here we are at Dolores Park.
I mean, you've been doing this like 15 years.
Yeah.
15 years, that's a long time.
This is a long time.
Does it ever
We're in
get,
tech standards.
Does it ever get like lonely at the top?
Oh yeah. You can have all the money in the world, all the success in the world, but the thing that makes most people happy is just connections and relationships.
Watch The Circuit with Emily Chang, Thursdays, 10 p.m. Eastern on Bloomberg Television, or 8 p.m. Eastern on Bloomberg.com or the Bloomberg app on connected TVs.
We had a long-standing presence here in Houston for the past, I would say, 20-some years, since the Compact merger. We bought a piece of land, we started building this building. And in doing so, we had to also recalibrate how we were building it because the pandemic hit us. And we thought about recreating a work environment that is very, very different, that is catered for this new structural way of working, which we call edge to office, where people don't always come to the office to work, can work remotely from their homes, their edges, but have to come back to the office for specific reasons, such as team meetings, customer meetings, and in general, collaboration.
With regards to the hybrid work model, do you see that as something that will persist longer term when the pandemic is long gone?
Yes, no question, this will persist.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people,
There's no question this industry is composed of some bad actors and some good actors.
the transactions,
Volumes have surpassed $24 billion per day.
and the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
This is the sweet spot of people capitulating, beginning to chase this rally higher.
We're going through a regime shift in asset allocation.
The market has a lot of confidence that the Fed's going to be able to see inflation back down to 2% in a year.
These high rates are going to start to impact.
Central banks started out well behind the curve. They're catching up, but they have a lot of work still to do.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
It is Countdown to Chair Powell. Good morning. Welcome back. This is Bloomberg Surveillance on Bloomberg Radio and Bloomberg Television. Tom Keene, Jonathan Farrow, and Lisa Abramowitz. Jonathan Farrow is on vacation today, and he will be on vacation, a well-deserved one for the next couple of weeks. It is something that everyone should enjoy. Occasionally, we are waiting for Chair Powell to take the helm over in front of the House in Washington, D.C. at a time when a lot of people are saying, Tom, that we're probably going to need something more for them to curtail the enthusiasm we're seeing in the U.S. economy.
It's not what it used to be. Mike McKee out with a Humphrey Hawkins tweet today, and it used to be that they didn't talk, and the only thing that matters is what the chairman, his name was Greenspan, said. And so Humphrey Hawkins, there was a huge anticipation, and now, which you've been great about, we've got the speech-a-thon by presidents, governors, vice chairs, and the chairman even, once in a while, less so. But I just don't think it's the same given the over-communication that we have today.
Well, the over-communication, what's been the takeaway from it? We don't know. We're looking too. I mean, honestly, what kind of communication is this?
People know where I stand on this.
But this, to me, the lack of certainty around the data has really been highlighted. Andrew Hollenhorst of Citigroup just publishing, talking about the surprise surge in housing starts, the biggest going back to 2016. Home builder sentiment rising to the highest going back a year. How much does that change the narrative when Fed Chair Jay Powell last week was talking about how the housing market was getting decimated by the high rates? I'm exaggerating, but that's essentially his message.
3-month T-bill, 5.27%, the 2-year 4.71%. With the curve inversion, we see 97 basis points. I mean, the tension is still there. I guess we're waiting for economic data after we wait for Humphrey Hawkins this morning.
Yeah, we're going to get some economic data, the likes of KB Homes. They're going to be reporting earnings after the bell. I think at this point, how much are we hearing, Tom, from a number of strategists? Earnings are going to make it or break it, particularly with big tech.
Yeah, I think that's true all the time. Earnings are part of it, but the question is, do you see a multiple expansion? We're going to address this in a moment with Alicia Levine, but the basic idea of a multiple expansion is maybe the key dispersion right now.
Well, so let's say Apple, let's say NVIDIA comes out and they don't blow it out of the water. No, seriously, just to bring in a little bit of gloom, right? But this is the real question. If you don't see the profitability from some of the AI-driven names, do you end up with the biggest market-moving event that puts the Fed to bed? I mean, how much is that what we're looking at?
I mean, NVIDIA is cheap 57 times earnings as compared to, that's the view next year, versus something like 80 for Tesla. So it's a value stock compared to Tesla.
I mean, I was trying to bring a little gloom because yesterday...
I'm just getting Alicia going. Yeah. She's dozing off over here.
Right. So let's get to her. I will say yesterday we did see a decline, a whole 0.2% decline on the NASDAQ and the S&P lower by about 0.5%. You're seeing a little bit of a softer tone today as well. Again, nothing to write home about, but the direction is interesting based on the melt up and how much that really shifts it, Tom.
Yeah, it is. It's a pause here. There's no question about it. We've seen a pause pull back 2 days in a row. I think a little more excitement today. I should note sterling off of horrific inflation in the United Kingdom, 1.27. Maybe that's why Pharaoh's not coming home. He's paid in sterling and he's looking large.
The 10-year yield up marginally. The 2-year yield higher by about 100 basis points since early March to 4.7%. And crude just a touch softer as we look out to the potential for slowing growth. Joining us is someone who is always an amazing voice, clear voice, to look through the noise and understand how to parse out what the next trajectory is. Alicia Levine, who is head of investment strategy and equity advisory solutions at BNY Mellon Wealth Management. Alicia, are you expecting anything from Fed Chair Powell today?
So I don't think there's a lot he could say right now that would change the market. It was clear last week that we're moving higher at the peak Fed funds rate. The Fed has been trying to talk this market down, and in the end, the equity market has simply ignored it. To your point, the 2-year has moved 100 basis points in about 2.5, 3 months, and through that, the market powered higher. And so essentially, the equity market says, we don't believe the Fed. They're not going to get there. They can't cause the pain. And they just don't believe it. And so I think that's what you're seeing, actually. See, on the one hand, you've got the bond market screaming recession. On the other hand, the equity market saying the Fed's not going to be able to do what they want to do.
I mean, you state obviously within it, this dispersion over earnings is extraordinary. I mean, the opinion is like the dots for 2025, make it up as you go. But that doesn't talk about the dynamic on the P side, which is the multiple expansion. Walk us through where we are now in multiple expansion and what that dynamic will be over the next 12 months.
So we're at a 19 times forward 12 months. That sounds high, but I will say that when you're coming off of trough earnings, the multiple can go higher, much higher, because the multiple expands, as you see, before the earnings do. So for a while, it can look like stocks are very, very expensive. And then what happens is that the earnings catch up. So the earnings dispersion is enormous, because if we do have this long projected recession this year, earnings can be as low as 195 for the year. But if we get that soft landing, you really could be in that 230 to 235, which is where estimates were a year ago for 2023, right? So we priced in a slowdown. If there's no recession, you get to 230 to 235, and then you grow from there. So can you see the S&P at 5,000, 5,200 in 12 or 18 months' time? Of course you can. And so that's really the story here. The multiple's not crazy if we don't get the recession.
Do you have an SPX number? Do you put at BNY Mellon? Do you put a number on it? They just really don't want
we do a range. Our high
range?
We do a range. So the range for this year is 4,500. Our range for next year is 4,800, but we're likely to go.
See that there.
We're likely to go higher. We're likely to go higher.
4,800.
Can we come on? It's a show. Nobody's watching. 5,000. I can't get anybody this week to say 5,000.
So the point being, though, where's the recession? And if there's no recession, all of a sudden your probabilities change, your earnings change, your multiples go higher, and then you get that really high multiple that doesn't make sense in a steady state, but does when you're growing off the trough.
When you say if we don't get a recession, haven't we already gotten a recession in certain sectors?
Yes.
So if we have, how does that factor in to this call?
Okay, so let's talk about Q2 earnings. Expected to be down 6% for the second quarter. If it comes in negative, more or less, we know we had that beginning of first quarter, we ended down 1 or 2%, but still there was an earnings recession, 2 quarters in a row of negative earnings. This would be the third. Okay, so we still have that earnings recession. We have a recession according to GDI, gross domestic income. Okay, so that we're in a recession there. And we've had this rolling recession that folks are talking about, but I think really does describe what's happening. And what was weak first were the sectors that really exploded in the beginning of COVID. So tech and goods, those rolled over first, took earnings with it, and then you're seeing the catch up. And so you can't really get a GDP recession yet because the services are the economy, and that's what's holding up the economy.
Do we get to 4,800 if the Fed keeps rates at 5% or even goes up to 5.5% for a prolonged period of time?
So you can. You can get to 4,800. The key thing is where's the credit contraction? Okay, so what it looks like is that the housing market, which should be the first trajectory through which higher rates filter into the economy, has not fully cracked. Okay, so the demand is so strong, supply is so low, prices are holding up, and we saw what happened with housing starts yesterday. So there was a slowdown, and in a sense, it's the rate of change. So if your mortgage rates are staying where they are and not ratcheting higher, you're getting people saying, okay, this is where mortgages are. But we need a home, and so we're going to pay it. So the housing market's not cracking. If the housing market's not cracking, then where else are you going to see the credit contraction? The banks have contracted lending, but there hasn't been an inflection in the trajectory since March. It's the steady slowdown that we've seen since last September. So there's no increase in the rate of change of that. Do you see problems in commercial real estate? In some cities, in some areas, it looks to be well defined right now. That doesn't, I don't want to sound Pollyannish, but right now, you'd have to say credit is contraction. And it's not everywhere. The markets are open for bond issuance.
She's doing her Haley Mills imitation. John from Capri emails in from Los Smeraldo, lunch at Los Smeraldo.
Okay.
Says, you know, we're talking to 5,000 with Alicia Levine. He says, what's the Dow equivalent? The Dow equivalent on SPX 5,000, Lisa, is 38,400. That's where Alicia, I'm making up this.
No kidding. Everybody knows you're making this up in every which way.
I'm trying to get Alicia to 5,000.
I want to be on vacation in Italy.
Exactly. And John would not be asking about the Dow. Absolute fallacy. I will say, if nothing is cracking, Alicia, does that mean you go all in? Do you buy this, or do you remain cautious and say, something doesn't feel right?
So that's not how we manage our portfolios. We manage our portfolios based on risk profile. So that's the first thing I have to say. I don't think you go all in here. The move we have had has been extraordinary, and it has been in the face of stickier inflation in services, with the Fed saying we're still going to be there. I don't think you can fully ignore it because there will be some tough moments. I think we're fairly valued here. So I think the summer could be a little bit of a difficult summer, or just a pricing and consolidation. But to the point of what's led the market, you really have to see the broadening out into the deeper cyclicals to keep this going. I mean, as of yet, you need to see the financials, you need to see energy. You know, look, REITs are on their back. And so, you know, you have to see some broadening of participation. The cyclicals also went through their recession a year ago. PMIs have been below 40, below 50 for a while. This is where you buy these stocks. You know, you don't buy the stocks when PMIs are 56. So it feels like the recipe is there for that, but you always have to look for what the next trade is. We've come really far, really fast. And you have to see the small caps work. You have to see the cyclicals work. You have to see the dividend stocks work.
Alicia, thank you so much. Alicia Levine, I couldn't get her to 5,000. I failed. We'll work on it. I like the banded idea. That they don't do a single point, they do a banded idea. Futures -7, Dow futures -34, the VIX 13.75. Standard & Poor's 500, it is down 0.2%.
And this comes as we do await Fed Chair Jay Powell, who is poised to take the helm over on Capitol Hill in about an hour and 45 minutes. Whether it matters is another question, Tom, at a time when people are looking at the underlying dynamism. We haven't talked about the thing I've been really focused on the most over the past 24 hours, and I'm kind of embarrassed to say this, but I've been looking at this submersible. I've been tracking it and trying to understand
what a difficult story this morning.
What it must be like to be trapped 13,000 feet under the ocean, waiting for someone to find you. It's a horrific story.
It's a horrific story. To review this, if people haven't followed it, it's been a mystery, and then reports by the Boston Coast Guard through them of a little bit of research on noises from the water. The conventional thing is banging, if you will, on metal, and it's hugely difficult sonar technology that we're guessing against this timeline of oxygen.
Well, the technological kind of discussion over the idea that people are probably banging on the side saying, hey, we're here, and how do you find them in the race with oxygen quickly running out, less than 40 hours, it sounds like here. We will track this, but the global effort to find this vessel and bring it back has been tremendous, and we'll keep watching it and hoping it has a happy ending.
Well, we'll look for a happy ending, but right now it looks to be very difficult. Bloomberg is following this from London and from New York, and certainly from our Boston offices as well. Futures at -8, Dow futures -42, single point. Let's go to pound sterling, $1.2721. Flat sterling within the absolute shock of core inflation across the United Kingdom. Coming up on Her Washington, Henrietta Trey's of Veda Partners. On radio and television, this is Bloomberg's Surveillance.
multi-trillion-dollar industry. There's a lot of ground to cover.
A record year of growth, hand over fist all year.
We're just getting started.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Today on Bloomberg. From the world of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
From New York City,
From London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
The relationship and the communication between the two leaders, between President Biden and President Xi, is most important of all. That's why they've had a number of communications and meetings to date, and that's why I expect you'll see more of that in the time ahead.
The Secretary of State of the United States, I will editorialize with a sense of exhaustion there, and his travels here the last number of days has been extraordinary, from China to other points and then to Washington as well. Blinken there on Ukraine. Maria Tadeo tomorrow with an important interview in Bloomberg Surveillance with leadership from Ukraine. Looking forward to that. Part of the joy that we have is we get to read our guest notes. Our team does a great job of collating in all of their thinking. And to read Henrietta Trey's is like poetry. She writes completely different about Washington than what you see in the newspapers. Economic Policy and Research Director at Veda Partners, Henrietta Trey's has a curtness and directness. And what's stunning about your note, Henrietta, is your directness about we're delusional, we're going to cut spending. You go into the Pentagon budget, paragraph 1, paragraph 2, paragraph 3, you're basically saying you're out of your mind if you think there's any austerity on Capitol Hill. How did we get here?
Well, that's really kind of you, Tom. And unfortunately, I'm like that in real life also. So I'll just be really honest about it. I mean, we had a big fight about deficit spending over the debt ceiling negotiations or debacle, if you will, as we all covered at the time. But at the end of the day, the reality is you do not have the votes or even really the will to reduce this federal spending in any kind of a meaningful way. And as the Federal Reserve is making decisions on whether to hike interest rates, pause, or anything else in the next couple months, we have to be clear-eyed about whether or not the federal government is going to continue to provide increased federal spending or reduce federal spending, as you know, your macroeconomist at your hedge fund or wherever is trying to price in exactly what's going to be coming towards the economy in the next couple of months. And the reality is, as we're going to hear from Blinken, Secretary Blinken later on today, there's going to be additional calls for funding for Ukraine, as we have had since the start of the war. I assume that's going to be at least somewhere in the $30 to $60 billion range. You have Republican members calling for increased aid at the border, $12 billion here, $15 billion there for fentanyl or Title 42 or what have you. Then you have increased calls for all of the flooding or the hailstorms or tornadoes or hopefully not, but any hurricanes that happen. These emergency supplementals are loopholes you could drive a truck through that are in that deficit debt bill. So that's what's coming our way in September.
Within the granularity which you're expert at, how do you perceive people like the Peterson Institute, or frankly what Peter Orszag did years ago at Brookings, or what Center on Budget, the Center CBO, the Congressional Budget Office? How do you perceive how close we are to a fiscal panic as you people spend?
You can get stuff from like the CFPB that says, hey, we really need to rein in our deficit. And you will hear that from certain members on the Hill. But the reality is there is no likelihood of materially reduced federal spending. You know, we have a debt ceiling of $33 trillion basically by this time next 2025 or the first quarter of 2025 when they have to hike it again. There is an effort maybe to trim $150 billion in federal spending. I mean, that's literally a drop in the bucket, less than a drop in the bucket. So there are no material efforts underway, and CBO effectively prices in the near term, but none of the long-term stuff. And they're pretty blunt about it also. If you read their scores and some of the footnotes, they just do not assume savings where there aren't going to be any. The perfect example would be clawing back the COVID relief aid that went out during the pandemic. In parts of that, they don't even factor in savings because they also just assume that that money wouldn't go out anyway. So they're pretty clear-eyed. I love the Peterson Institute's work. I think it's tremendous and follow it closely. But you really have to, nail senators and congressmen down and get them to hear what they're saying about any of these realities. And that's often overlooked in the rush of the day-to-day.
And it's also overlooked because nobody cares. The focus is squarely on Hunter Biden and the former President Trump's legal troubles, which has sucked all the oxygen out of the room. How much is that going to dominate the election cycle, much more than anything of the nuts and bolts of how the economy works?
Lisa, it's such an incredible question because there is a huge tax bill that is hanging in the limbo coming up on the next election. 2025, all the 2017 individual tax cuts expire. And the R&D and the EBITDA shift and all those components have already dropped off and the individual stuff will expire. So you have this opportunity for a huge conversation about fiscal responsibility, pulling the subcommittee, the super committees that we've talked about before back together. And none of that is taking front and center position because we're talking about Hunter Biden, because we're talking about, 3 or however many indictments there are against President Trump, the Republican infighting with 15 different candidates on the walk. I mean, there's no shortage of other things to talk about, and no one's concentrating on the tax policy stuff, which is a shame because it's a winning argument for voters who care more about the economy than any other issue.
And it's coming at a time where these aren't just window dressing topics. And I think about the case against former President Donald Trump and the court date that was set that was really quick. Unclear whether that will actually be a real court date. How much does that shift the landscape, though, heading into an election cycle where this is the proposed frontrunner for the Republican Party?
Well, this is sort of what I tell to clients. In order to combat President Trump, he really needs to either go to jail, be indicted, or bow out of the race. Because right now, no other candidate has a shot. If he is plus 33 against his second closest competitor, even if DeSantis were to make humongous strides in fundraising, in voter outreach, in turning people's minds around, he's still only halfway there and still down, call it 15%, even if he, cuts his lead in half. So there really is not an opportunity for another candidate. And then, you have the Pence, Haley, Chris Christie lanes, then they poll below 5% every single time. So Trump is the clear and away frontrunner. It is historically consistent. Fighting against that is the fool's errand, I think. I assume that the candidates are Trump and Biden. This is a relitigation of 2020. Right. And as we have seen every election since 2018, when Trump is at the top of the ticket, Democrats win and Republicans lose, sometimes by historic margin.
Henrietta, we had Eric Cantor in London with our Francine Lacroix. Let's migrate over to the House. How's Kevin McCarthy doing? 45 seconds. How's Kevin McCarthy doing?
I think he's fine for now. He will be in for a heck of a time in mid-September. All he's doing is staving off the inevitable. We could very well have a shutdown. The odds are rising. You're going to see these emergency supplements, OCO spending. He's going to have a tough walk ahead. It's going to get uglier.
Thanks for the brief. Henrietta Trey's with us, Veda Partners there. I'm not framed that out through August that we get to a shutdown.
Well, some people are talking about that, given the fact that there still is some debate over what has been approved. And then, of course, there is this additional spending. I mean, she's right to point that out, how much the spending is actually going to be increasing despite all of the noise around the debt ceiling.
I mean, in the recent history back to Sam Nunn, Paul Tsongas, Pete Peterson, and the rest on the budget angst. But really, the budget angst back at least half a century on the expansion of our federal America. It's just been this one cry wolf of potential panic and outcome. And it's that way until it's not. You wonder when it breaks, when it snaps.
I'm a little distracted because Mohammed El-Arian just put out a column that caught my attention. The headline being persistent UK inflation should worry everyone, talking about how, yes, this is a UK story, but it points to a sort of trend that is ongoing with a lot of the central banks fighting a situation that is exacerbating inequality, creating a greater risk of stagflation, and creating higher borrowing costs for all. And this is really the concern as it grinds onward for a longer period of time.
This is the disaggregation theory. I mean, the idea that we aggregate our macroeconomics, I'm going to take it back to 1947, maybe, where this was codified in the modern day. I don't buy it. And, John Edwards, 2 Americas, maybe it's 3 Britons, maybe it's 4 Britons. But this is a huge societal story about the cost of inflation.
And it's really apropos to talk about this in tandem with the policy discussion. Mohammed El-Arian goes on to say, it reinforces the point that the urgent goal of bringing down inflation in orderly fashion cannot be met just through interest rate increases. Also has to improve the supply chains, productivity, and a whole host of other policy considerations.
Productivity is the unspoken there, something we talked about earlier. Jeremy Stretch, I believe, to be with us. He'll have a British look for us as well coming up. Francis Donald as well from Manulife. Francis Donald on the American economy. Stay with us. It's Bloomberg Surveillance.
top names in climate change are on Bloomberg.
I want everybody committed to the kind of action that we need. We have a global emergency now. You know, we're still putting 162 million tons of man-made global warming pollution into the sky every day, using the sky as an open sewer. That's trapping as much extra heat as would be released by 600,000 Hiroshima-class atomic bombs exploding every day. That's what the scientists tell us, and the data shows it. That's crazy. That's why we have a third of Pakistan underwater. That's why we have the historic heat wave in China, nothing comparable to that ever. That's why the heat records are broken every year. And we're seeing an increase in the flows of climate refugees crossing international borders that are due to vastly expand unless we take action to solve the climate crisis.
Nobody covers climate change like Bloomberg, your global business authority. Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
Bloomberg Surveillance, Jonathan Farrow on assignment, Lisa Bramwitz and Tom Keene driving through the week here. It's a more interesting day than it was on Tuesday, no question about that. Futures negative 12, little deterioration in the tape in the last number of minutes. But at least in the yield space, we continue to elevate yields, and we're not going to make 4% by the end of the show, but nevertheless, yields come up a little bit.
The grind higher has been tremendous over the past 2 months. That, to me, is the takeaway. 100 basis points increase since early May, just on the 2-year yield. We have reset expectations. Markets have powered through. There is a disconnect that either we've seen a sea change from AI and tech, or that something else is afoot, that there's going to have to be a reckoning.
We've got news now, and it is on Humphrey Hawkins. Michael McKee out with a wonderful tweet today on the history of all this. Coming out of the war, and little did they see the horrific deflation of 47, 48 coming, was the Employment Act of 1946. And then two people, Humphrey of Minnesota and Hawkins, I believe, of California, yes, Hawkins of California, decided to amend it in 77 and 78. I have the clearest memory of this being hugely controversial. But Mike McKee, it was done in a time when the chairman of the Fed really rarely spoke. Today we have massive communication of our central bank. What's the value this morning of the Humphrey Hawkins testimony?
Well, the prepared testimony for Jay Powell is out, and it's a bit of a Groundhog Day. Nothing new in the statement, a cut and paste job from his opening statement at the press conference last Wednesday. If you were going to pick a line out of it, you might say, inflation pressures continue to run high, and the process of getting inflation back down to 2% has a long way to go. And then he repeats the phrase we used as our key quote last week. Nearly all FOMC participants expect that it will be appropriate to raise interest rates somewhat further by the end of the year. But at last week's meeting, considering how far and how fast we have moved, we judged it prudent to hold the target range steady to allow the committee to assess additional information and its implications for monetary policy. His diagnosis of the economy, the same. The labor market remains tight, and the inflation numbers are well above their long-term 2% goal. They are seeing tightening in interest rate sensitive sectors, but the extent of that is uncertain, and they'll make decisions meeting by meeting. And in making those decisions, they will look at the cumulative tightening of monetary policy, lagged effects on economic activity and inflation, and economic and financial development. So if you liked what Jay Powell said last Wednesday, you're going to like it again today.
Sounds like over-communication to me. Mike McKee, can he move the markets today?
Well, he could. The question is going to have to be asked in the question and answer period of what do you mean by additional firming? Do you really think you're going to want to go 50 basis points as the new dot plot suggests? And if so, when are you going to do that? You said July was a live meeting. Do you anticipate raising rates in July? And would you go 25 or 50 basis points? Is this going to be an every other meeting kind of move? Those are going to be the questions that could move markets today. Powell also likely going to talk about bank reform, new regulations after the March issues, but that's not going to move anybody's needle.
Mike, an improvement would be if you could be the congressman from New York or whatever, and you could ask a question of Powell at the Humphrey Hawkins testimony. That would be a big improvement, I think, this morning. Michael McKee, thank you so much as we look towards this important testimony by the chairman. Frances Donald is with Manulife, global chief economist and strategist. She's very good at writing blistering bullet points that cut to the chase. We're going to cut to the chase, which is we all know the U.S. is way out front on inflation versus what we saw in the United Kingdom today, and even Europe, Japan being the oddity as well. And you look at the nonlinearity here. You pick the 0.3%. The answer is core inflation's coming down. There's a little bit of a vector in place, but you say the path to 2% is going to be brutal.
Well, the path to 3% is probably going to be quite easy. We'll be there in the next couple of months, and then a lot of people will claim victory.
Quickly?
Yeah, for sure.
Why?
And
I don't see it.
Well, a huge element of this is base effects that are coming through. That's just a big part of it.
Looking back 12 months.
But you do point out something really critical, which is that if we talk in year over year, inflation is healing. But for most Americans, and in fact global citizens of the world, their price pressures are not coming down. They're still paying substantially more than they did several years ago, and are still going to have that embedded view that prices are substantially higher. And that's why these central banks, the Fed, the Bank of Canada, the Reserve Bank of Australia, the BOE, cannot imply that rate cuts are coming. If they do that, we will see a reinflation of inflation expectations.
But they've basically said that. And you're still seeing a group of people say inflation is going to be hotter for longer. They don't have what it takes to actually come through with these expectations. So at this point, if they don't raise rates further, will they lose the battle with inflation?
Well, no, because a big segment of inflation is not coming from interest rate sensitive sectors. Yes, some portion of it is, but we are in a new paradigm in which inflation is being driven. I know we've said it for years now, more by global, more by supply side factors. So as we move forward, and this is why, this year is interesting, the July meeting is interesting, but what keeps me up at night is 2024 and onwards, because we're heading into an environment where 2 to 3% inflation, in our view, will become the norm, and central banks are going to have to make a decision. Do they continue to launch us into recessions or lower growth in order to put us towards 2%? Or do they admit that the nature of inflation is changing and 2 to 3% is more what we're going to be looking at?
This is so important, and there's a lot to unpack within this. If 2 to 3% becomes 3 to 4%, how do they make sure it stays within a certain range and keep their credibility? Are you saying that it would be a mistake for this Federal Reserve to go to 5.5% or even 6% in terms of a Fed funds rate in order to bring inflation down faster, because all they would do would be to torpedo the economic growth without necessarily changing that paradigm?
What I'm saying is that it's a mistake to ask central banks to solve inflation all by themselves. That as the nature of inflation changes, we have to have some hard conversations about what we're asking global central bankers to do. Now, the Fed has a little bit of an out because it has a dual mandate. It can look towards the employment side of the picture, which, by the way, they're going to have to change the metrics they look at in order to do that. There are other central banks that have single mandates that are only targeting inflation. Those central banks are going to have to say, what is the cost of 2% now that the nature of inflation is changing?
If you see the disinflationary trajectory you're outlining, a soon-to-be serious disinflation, what does as a labor component non-farm payrolls do? I mean, we have people that come on that suggest we could see an abrupt decline in non-farm payrolls. Do you buy it?
Here's the issue with the employment data. Now, in the past, we would look at non-farm payrolls as a good indicator. We would look at the unemployment rate, which, of course, is what the Federal Reserve
So what do you look at if you're not looking at them?
I am looking at weekly hours worked, among other indicators. And the reason for that is we have companies that have been very clear they are still scarred by the labor shortages that have persisted over the past several years. They will attempt to cut costs, likely in ways that are not laying people off. But what we're likely to see is you stay employed, you get to check that box, but the amount of hours that you're asked to work decline. Now, weekly hours is already back to pre-COVID levels, and yet I hear all the time, but the labor market's on fire. Well, not if you look at the actual amount of labor being consumed in this environment. The unemployment rate rate is still going to be probably rising very slowly. We don't actually have it going above 5%, even in a recession, but the amount of labor consumed is going to be lower. This is why our metrics have to broaden.
Lisa mentioned earlier something we've talked about in surveillance for quarters, I would say now, which is the solution is patience and expansion of the x-axis where they stay higher for longer. To me, that's just it's a more efficacious move than to worry about 25, 50 beeps up, down. Do you buy that?
Absolutely. Well, the solution to most things is patience, Tom and Lisa. I agree with you on that one. So when we discuss our forecasts, yes, we have penciled in one more rate hike for July, but what we spend much more time thinking about is the response to the next recession. And at this point, what we're looking at in 2024 is, yes, the central banks do cut, the Federal Reserve does cut, but only towards what they view as neutral, that they don't actually go into easing territory, they stay restrictive. And of course, that brings a question that I know you love to ask on this. What the heck is neutral? That we don't know for sure.
When you talk about the resilience in the face of the rate hikes and the lack of interest rate sensitivity in certain areas, what do you make of the fact that markets have continued to rally, that we've erased all of the losses incurred since the beginning of the rate hikes, and that we've seen two-year yields rise by 100 basis points in the past month and a half?
I think you used the word reckoning earlier, which is, I think, an important moment. We have historically, for my entire career, believed that as you face a recession, central banks respond. And indeed, you know, my job on the buy side working for an asset manager is to input our forecast to see what different asset classes are going to do. In a recession, we start saying, okay, there's going to be an opportunity for equities, for fixed income throughout this. But when we start modeling recessions without material rate cuts or with less rate cuts, then we actually see a very different asset class return. It is not a standard recession playbook. So what I think is happening now is a market that's coming to that realization that recession or bank failures does not equal rate cuts. This is a paradigm change from how we've looked at things.
So why is there such a resilience, right? If that's not going to be rate cuts to the rescue, is that reckoning going to be lower, or is it going to be that maybe this economy just isn't interest rate sensitive in the way many people expected?
There is an element of that, and there's certainly no shortage of soft landing. Now, the issue I have with that and why I think there's a disconnect right now between equities, which are being distorted by the AI story, there's no question about that, and fundamentals, is that every single leading indicator of a recession is flashing red. Deeply red, Lisa, like flashing red. So even if I say to my team, okay, I want you to cut in half those indicators, is it still a recession? The answer is yes. So if you want to make the point that it's a soft landing, you have to discredit the bulk of indicators that have traditionally told us a recession. And you can do that. And there are some strategists that have made very good points about excess savings and labor shortages, but I'm not quite there yet. So a recession ahead means there's a disconnect between prices and fundamentals. That's when we make money, Lisa.
30 seconds, quick. Is the stock market disassociated from your cautious economic view?
Yes, but that's okay. We have tactical time frames, medium time frames. Macro is not everything all of the time.
Canadian thing, medium time frame.
As much as I would like macro to be the driver, sometimes you have to trade off of momentum, technicals, and sentiment. If you're a tactical portfolio manager, that's the moment. And recession may still be a couple months away. So sometimes there's a disconnect. Depending on your time frame, that's also an opportunity.
Francis, thank you so much. Francis Donald with us with Manulife of Montreal. Manulife Investment Management, I should say, as well. Yeah, I look at this, and there's like, as we know, that's what makes surveillance go. There's 42 different opinions, 42 different flavors out there.
I love what Francis was saying about every indicator flashing red. How many people have said, well, the indicators are broken? How many people are saying this is a different time? And nobody wants to say this time is different, but everybody's saying this time is different. And more people are saying soft landing, no recession, simply because, you know, we are seeing a pandemic distortion that we haven't seen since 1918.
The 210 spread out to 97 basis points. On the SPX, Standard & Poor's 500 down 0.2%.
I will just say that I'm going to be filling in for John Farrow in the next hour. And coming up, we've got some incredible guests we're going to be speaking with as we bring you into the open. Brian Weinstein of Morgan Stanley, he can weigh in on this. Anastasia Amoroso, iCapital, and Patrick Frizzetti of Hightower. And we'll be talking about this dissonance that we've been seeing about these forecasts for recession that people are kind of ignoring more and more, even as the Fed kind of is getting uncomfortable by not.
My head's spinning from the opinions today. They're all over the place. I mean, it's extraordinary to me, the difference. Somebody had mentioned the word dispersion. I think it's Alicia Levine of BNY Mellon mentioned the earnings dispersion. There's a theory dispersion going on right now. I mean, I literally could write it. I do like a LinkedIn essay on that. There's a theory dispersion out there.
When it comes to how long rates have to be high, when it comes to whether we are going into a higher rate environment, as Francis was talking about for the longer term, or whether we're talking about something going back to what we used to know with respect to low rates and low inflation. And that's the dispersion. We have completely disparate views on that.
I mean, I'm looking at 2-10 spread plunging here in the last number of minutes, no doubt off the Powell testimony and the non-event of it, as Michael McKee covered. We'll have that for you on Bloomberg here later this morning. But we're at 97 basis points. The difference in yield between the 2-year and the 10-year is almost 1 full percentage point, the 2-year higher. And you know, it's moving with some real strength, is another way to put it.
It's really within spitting distance of the lowest going back to 1981, the last time the Fed was on this type of hiking cycle.
Some of the historic scale, of course, we saw that in the United Kingdom this morning. Thanks to Neil Shearing of Capital Economics. It was just wonderful on UK analysis. Futures at -11, the VIX stunning, 13.80. This is Bloomberg Surveillance.
You're so intimately linked to the future of the UK. What are you seeing when you go to branches and in the country?
Yeah, we're seeing a lot of anxiety at the moment. You know, I think the recovery from the pandemic has been and is continuing to be very strong. So I think we're seeing the economy recover. But with rising interest rates, with inflation, those are things that, you know, peoples and families and businesses haven't had to deal with for 10 years. So a lot of business owners today haven't had to operate in that environment. So it's causing quite a lot of anxiety, which means, you know, for us, because we're up and down the country in branches and offices, we can spend a lot of time talking to businesses and helping them plan and deal with it. But it is, you know, it's very different, and it's not something people have had to operate in for a long time.
Our studios in New York and San Francisco. Our expert hosts have the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority.
DOJ or other authorities
could face bigger challenges next.
It was going to keep rate World Cup. This is a 3
as the economic picture does. The BOK is getting ready to make a decision.
I think we can all agree that the economy is a lot less interest rate sensitive than we thought. The way we're characterizing the economy is an economic malaise. We thought the probability of recession spiked with the banking crisis, but now we think that's come back down. And so we're really looking at an economic malaise more or less than a recession on the horizon.
Chris Harvey, Wells Fargo, really interesting there with a bullish construction on the market and a terrific analog study back to the late 1990s into 2000, 2001 on the tech boom that we're all living. I really urge you to find that report from Wells Fargo. Chris Harvey from Wells Fargo this morning. I wanted to take a pause here, and I understand it's mid-morning in the United States of America, but what's going on in the United Kingdom is absolutely extraordinary. Lisa Abramowitz just mentioned the writings of Mohammed El-Arian just out moments ago. It's something we'll digest through the day. We'll look at all the different economists. Neil Shearing, thank you for joining us earlier. But I thought we needed someone grizzled and ancient who really understands the value and dynamic of foreign exchange and sterling dynamics as they tell the story of the United Kingdom. It is a fear about core inflation. It's a fear that clearly we'll hear from Capitol Hill types talking to Chairman Powell this morning. And we get a brief now from London. Jeremy Stretch joins us, head of G10 FX strategy at the Canadian CIBC. Jeremy, thank you on short notice for joining us. I just thought your note was absolutely brilliant. The regression on cable, on sterling US dollar, is just simply weaker sterling since 2016 and Brexit. Is that slight, modest, measured depreciation still in place? Is there still a structurally weak sterling?
Well, thanks for the introduction, Tom, with the grizzled veteran element. But I think in the context of sterling, I think we have to remember that this week will mark the 7th anniversary of the UK population deciding that it wanted to exit the European Union. As a consequence of that vote, then we did revise down, or we would assume that there is a lower threshold for an equilibrium value of sterling than would have otherwise have been the case. So we are in this sort of lower for longer trajectory because macroeconomic activity will be less robust. And ultimately, as we're just demonstrating in terms of the recent inflation print, the structural inflation dynamics are somewhat higher. And clearly, when you have an inflation differential, which unfortunately is in favor of the UK relative to elsewhere, that invariably implies and results in a currency which needs to depreciate and underperform. So we have seen a sterling recovery from obviously those lows that we saw back in the autumn of last year during the Truss fiscal debacle, when there was that immediate fear of parity. But I think we're now in a situation where we're back into a sort of a 120, 140 range as a sort of longer-term fair value range. And ultimately, if we do get to the midpoint of that, I think it's tough to see any obvious reasons or suggestions to move substantially higher.
If I was in London with Francis Lacroix, we'd be looking at euro sterling, folks. But because of its 8:49 Wall Street time, I'm going to really stay on cable here, which is sterling dollar. And, you know, I look at this Jeremy stretch, and the obvious idea is how much can sterling reach out, even given the challenges of the greater United Kingdom? Dare I say we get back to a 140 like 2018 or early summer 2021?
No, I think that is by far a step too far. So if we have that sort of 120, 140 range as the sort of the basic broader principles for the sort of sterling trading range, I think it's tough to see how we were going to get to the upper extremities of that range over the course of the foreseeable future, because clearly as UK terminal rates have been pushed higher over the course of the last month or so in particular, as the inflation pressures have become amplified, then if we do see terminal rates being priced at roughly a 6% threshold, which we have done periodically, then that just amplifies the recession risks vis-a-vis the UK into 2024. So whilst we can talk about the hard landing or otherwise in terms of the US, I think the UK is infinitely weaker in terms of its fundamental story relative to where the US is. So it's rather difficult to see how we can see a material appreciation of sterling beyond the sort of maybe 130, 132 extremes over the course of the next 12 to 18 months. So I think that 140 threshold, I think, is very much off the agenda for the foreseeable future, unless you take a materially weaker dollar narrative than we would be prepared to accept as far as CRBC is concerned.
Jeremy, I want to get to a dollar discussion, but I really got to look at renminbi on an absolute devaluation tear here. Renminbi from 6.70 yuan breaching out this morning, folks, to 7.18. The high was 7.19 yuan. This is on a tear. Jeremy, from where CIBC sits with all of its Asian heritage, is this an orchestrated depreciation, or dare I say devaluation by Beijing, or is this a free and floating currency?
Well, of course, it's not technically a fully freely floating currency, but I think investors are looking at the macro dynamics in China and particularly reorientating their expectations of the reopening narrative and coming back to the conclusion that clearly the macro dynamics that we'd hoped for as China reopened are not as constructive and robust as we had hoped for or anticipated. And so we are seeing the currency depreciate and reflecting that weaker economic performance. Also, I think investors were obviously a little bit nervous or a little bit disappointed in the context of that reduction in the 5-year rate earlier in the week, because there had been some hopes that there would be a greater reduction to try and stimulate the real estate sector a little more aggressively. So I think it's more a case of disappointment regarding the reopening narrative. I don't think it's necessarily a managed depreciation or anything of that magnitude. And I think if we do see anything north of 720 in the nearer term, I think that does feel as though that downtrend in the CNH is relatively fully valued And ultimately, I would still expect by the end of the year that we're probably going to be trading back towards the 7 threshold and perhaps a little bit back below it.
On radio and television, Jeremy Stretch, CIBC, with us this morning. Let me get back to the center tendency, which of course our American audience is most focused on, which is dollar durability as well. Jeremy, I've been worn out by people calling for weak dollar. It just really doesn't happen. Give us an update on the CIBC view on the full faith and credit dollar.
Well, I think in the nearer term, I think there is still some value to be had in the dollar. I think in the context of the Fed, I think the market is still perhaps underpricing the possibility of the Fed pushing through not just one July hike, but I think possibly September 1 as well. So I think that's underpriced for the market. So I think they can and should see the dollar gain some traction off the back of that. And I was just listening with interest to some of the conversation you had with Francis Donald earlier from Manulife, and we would agree that I think the Fed will certainly hold rates at a restricted level for somewhat longer. So I think that's also supportive for the dollar valuation. However, having said that, I think there is still that globalized demand for that diversification away from dollars over time. So I think in the next 2 to 3 months, we can still see the dollar making gains and still being pretty robustly supported. But I think over the medium run, so sort of 6 months and beyond, then I think we can see just a graduated but modest degree of reduction in dollar valuations.
John emails in from Capri. John, thank you so much for listening to us on Bloomberg Radio this morning, or this afternoon, I should say, over lunch in Capri. John in Capri wants to know, Jeremy, what's the tradable pair right now? Where is the opportunity among all the pairs you look at?
Well, I think in the context of all the pairs, I think you need to look at those that are probably becoming most dislocated from market rate expectations. So I think certainly, as I say, I think there is valuation in terms of the dollar story as we reprice the Fed over the course of the next 2 to 3 months. I think in the yen, I think there can and should be some opportunities in the yen as well, because markets are giving back their expectation of any policy change from the BOJ, but I think we shouldn't downgrade that. And I think in terms of some of the Scandinavian currencies, we've seen those pretty beaten up over the course of the ensuing months. And I think there's certainly some potential there for a snapback if we start to see that sort of downside risk in terms of the global story starting to find a little bit of a base. And I think that would be much more constructive for some of those Scandinavian currencies as well.
Terrific brief. Jeremy Stretch, thank you so much, particularly there on the United Kingdom. He's with CIBC in London. I really can't say enough, folks, about the shock that we saw this morning on core CPI in the United Kingdom. I don't care how far removed you are, like I'm removed from it. The duration back, as I believe Lisa mentioned, 31 years back, to see that kind of persistent core inflation, and as Dr. Alarian mentions, the societal effect of that is really something. Jerome Powell to speak this morning, that will be important. Michael McKee with his treatment of those embargoed headlines. This afternoon, this off of Bloomberg Technology in the 3:30 hour, look for the president, the chief executive officer, Antonio Neri of Hewlett-Packard Enterprises. This is Bloomberg. Good morning.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
I'd like to kick off with a very simple question. Has the whole Brexit process been messier, less messy, or as messy as you expected way back in 2016?
Was it as messy as we thought it would be? Probably was, and I tell you why, because of the fundamental mismatch between, if you like, rational policy in the UK and what was, in a sense, performative ideology in the UK. And I think that was the problem. We could have had the deal, the so-called Windsor deal, several years ago, but the Johnson government simply did not want a deal on those terms.
But I think for the short to medium term, the next 3 to 5 years, the Brexit will be net negative on the UK economy, no question about it. What happens over the longer term depends on what the British establishment or the future UK governments do. One, I do think ultimately they will finish up in the next 10 or 15 years putting some kind of, I call it a trade deal with Europe similar to Norway or Switzerland. I disagree with Declan. I think they will pay into a European budget. I think they will have no choice. It is too big. The fundamental strength of the single market is something that is too attractive for the UK economy to be excluded from.
Maybe the messier part is yet to come.
Did art conservation help you in any way to be a better investor? And should a lot of good investors learn how to be an art conservator as well, or not?
I think in conservation and art history and liberal arts, I think differently than a lot of people that have just done finance. And also, I think I mentioned one of the things is to do conservation, you have to really do a lot of pre-work before you actually do a treatment. And so a lot of that pre-work is very similar to what I do in due diligence for investments. Lots of testing, lots of thinking about what could go wrong, lots of research. When I was an art historian, that was in the old days before the internet, but you'd sit in the stacks and you'd pull one thing in a bibliography on this and you'd sort of like a mosaic theory, put all these things together. I feel like I do that in my due diligence.
When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
From New York City for our viewers worldwide, I'm Lisa Abramowitz in for Jonathan Farrow. A softer tone for day two, led by the NASDAQ. The longer the session goes, the more the losses build. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Coming up, investors are cautious ahead of Powell's congressional testimony. Global central banks feeling the heat as UK inflation surges to a 31-year high. And as Tesla's world, we're just living on it. We begin with the big issue, all eyes on Powell.
We've got Jerome Powell.
Powell's testimony on Capitol Hill.
Powell has a tough job.
They didn't do themselves any favors, frankly, skipping.
He has a split view on the Hill.
There will be questions about what makes you up your hikes again.
He definitely needs to sound hawkish at the testimony.
He needs to be a bit hawkish.
As hawkish as possible.
He's going to strike a balance, perhaps a little bit on the dovish side.
He's going to have to sell, yes, we can get inflation down, but without a major recession coming.
Can we get a bit more clarity on the message from last week? It's been a communication dropping of the baton here, and we need to get it back in line.
Powell was unwilling to commit to July.
I'm very curious to see how the market reacts when Powell speaks.
If he pulls this off, it'll be unprecedented for a Fed chair.
Joining us now is iCapital's Anastasia Amoroso and Morgan Stanley's Brian Weinstein. Thank you so much for being with us. Anastasia, what are you expecting to hear from Jay Powell? Is he going to be doing a cleanup job from what we heard last week?
Well, I think so, Lisa. I mean, the message that he really delivered to the markets last week is that we're making progress on inflation, but we're not quite done. And I think what the markets really heard is the first part of that sentence, which is we're making progress and the conditions are in place and we're close to our destination. And I think he did a really good job delivering that message. And again, it resonated as the markets rallied. But now he may want to focus really on the second part of that message, which is the part where we're not quite done. I mean, inflation in the U.S. is 4 or 5%. It is not yet on pace to 2%. And so I think he may reiterate that that may require some more tightening. And at the very least, it's going to require us keeping 5.25% for a prolonged period of time. So I would, as a lot of the speakers just said, I would expect a hawkish tilt to this for sure.
Brian, what are you looking for today?
You know, I think Powell did what he wanted to do last week. I think he was intentionally, I guess, hawkishly vague. He wants to hike, but they really want more time, Lisa, right? They don't want to do anything at all. I think to have no dissents in that meeting, he promised that he would speak hawkishly, and that July was in play. But if you look at the market's reaction, I think it's not far from what they wanted. The market's pricing in a soft landing. It looks pretty good. So he'll be hawkish, but I don't think he'll break any new ground.
Well, this is the surprising aspect to me. They have the market convinced that they are going to raise rates and hold them there for longer. There's a pricing out of rate cuts later this year. There's been 100 basis points of an increase in two-year yields just since early May. Anastasia, why have risk assets continued to rally even in the face of a hawkish prognostication and a belief in markets?
Yeah, I think it's two reasons. It's first of all positioning and this chasing that we've been talking about, and second of all, it's this belief in economic activity and that it continues to hold up. And I think both of those things are credible. You know, it's great that investors have been adding risk here. They hopefully have benefited from this rally. And at the same time, we know the U.S. economy is holding up thanks to the consumer. We got the retail sales last week, for example, kind of confirming that. So I think there are really good reasons. And Lisa, it also speaks to me that there is some constructive developments in this market, as despite the fact that we priced out all the rate cuts that we previously priced in, the market is rallying. So that does tell you that there's more to it than just us trying to bet on the Fed cutting rates. So I find that to be a constructive development. Now, having said that, the positioning and the chasing is no longer likely to be the big tailwind that it was for the last 6 or 7 weeks. And that's why, as you know, things go parabolic. They don't do so in perpetuity. If the right catalyst comes along, they tend to correct, at least partially. And I think we're looking at a catalyst this week, which is potentially hawkish Fed Chair Powell.
Well, Brian, do you agree that the signal from equities, from risk assets, from riskier securities in the bond space rallying even in the face of higher yields is actually constructive, or do you think that this is the ostrich syndrome of people hiding in the sand?
Well, Lisa, when I look at where to hide, I mean, we've all spoken about cash ad nauseum, right? Investors are speaking with their wallets. 5% is great in the front end. Long forwards in risk-free rates are in the mid-threes. I just don't think it's high enough. So I think investors are happy to take 5% on one end of the barbell. But when I look at 10-year treasuries, I don't think it's not high enough yet. So it doesn't surprise me that given earnings are holding up, we seem to be getting some rebound in economic activity, housing, other places, consumer is okay. I'm surprised the yield curve hasn't bear steepened if they want to challenge the Fed until we get higher yields on the longer part of the curve. I think people continue to buy risky assets.
Well, exactly to that point, Brian, we heard from Mohamed El-Arian. He wrote a column earlier this morning, the president of Queen's College in Cambridge and formerly of PIMCO. He wrote, the implications extend beyond Britain in a multifaceted way. He was talking about the UK inflation rate. Today's UK data serves as a reminder to all that there is a real cost to falling behind in the inflation battle, and one that increases over time. It erodes the credibility of policymaking when it's already struggling to respond to more complicated problems. From your vantage point, Brian, is this what you're looking for? Basically, people saying, okay, maybe they're not that serious about fighting inflation, and to start pushing up the yield in the long end to indicate something that creates a bit more pressure.
Yes, I mean, when we get to minus 100 on the yield curve, which is 2/10 around where we are, 90 or so, it's historically very, very flat, and you wonder if the market wants to push back on the Fed, if Powell's testimony is not hawkish enough, if the Fed meeting didn't do enough for the market, where is that risk premium, right? That's what could challenge risk assets, give investors a real alternative out the yield curve in fixed income. It's just not there. I do expect, if we get any strength in the data to continue here, that we're going to start to test that, and we're going to see if this Fed really does want to hike rates or not.
Anastasia, from your vantage point, do you agree that if 10-year yields start to rise, if people's longer-term inflation expectations and rate expectations rise, that will be the game changer for risk assets?
I think it would, Lisa. That's one of the big reasons why tech had the rally that it had earlier this year, is because of multiple expansion as the 10-year yield was declining. I mean, I do agree that if the 10-year starts to rise, we're now repricing the longer-term inflation expectations. And fortunately, in the United States, what we've been recently repricing is the growth expectations. That's what drove the 10-year yield from 3.4 to 3.7%. But to the extent that the 10-year starts to rise because, all of a sudden the inflation expectations start to become more entrenched, that would certainly cause a problem for risk assets. And, to kind of go back to the point, Lisa, you were making about the UK CPI, I mean, it is stunningly high, but I also think it kind of showcases how the Fed has actually done a good job of getting ahead of the curve finally. I mean, if you look at the UK, you've got the inflation rate at 8.7% and their Fed funds rate equivalent of 4.5%. Now, that means that the rate is below the rate of inflation. That's not the case anymore in the United States. And the Fed at 5.25%, 5.5%, that's over and above the core PCE inflation of 4.7%. So that, to me, really sort of demonstrates that the Fed actually has finally done a good job of getting ahead. And I think that notion will give the Fed the opportunity to pause over time. And for investors, global, seeking to allocate to global equities, that's why they're going to continue to prioritize U.S. equity.
Well, we will hear from Chair Powell. He will be in the hot seat today. He is heading to Capitol Hill. His semi-annual testimony before the House kicking off in about 52 minutes' time. This is President Biden's Fed nominees are set to face the Senate Banking Committee as part of their confirmation process. Joining us with the intel and the prepared testimony so far, Bloomberg's Michael McKee here on set. Michael, what have we learned from the testimony? What are we expecting to hear?
We haven't really learned anything, Lisa, because as the late, great Yogi Berra once said, maybe, it's deja vu all over again. Basically a cut and paste job of his opening statement at the news conference last week, in which he promised the Fed is going to do more. Maybe. Here's the key quote. Inflation pressures continue to run high, and the process of getting inflation back down to 2% has a long way to go. And he cites a tight labor market, a very tight labor market, inflation well above their longer run 2% goal. They are seeing some tightening affecting rate-sensitive sectors, but the extent of the effects remains uncertain, and he promises they'll make decisions meeting by meeting, which leaves open this question. Will the Fed be raising rates? Will they raise in July? Do they raise in September? What do they do since they don't know what's going to happen to the economy? You can see the change in the dot plot here. The yellow is the new, the white the old, and on the far left there is how much they have moved up. Now that's what comes out in the summary of economic projections, what each individual member thinks is going to happen. But there's still a lot of people who think that don't need necessarily to go much higher. So the job of members of Congress today is to try to tease out from Jay Powell whether they do indeed plan to raise rates, and if so, when, and how high does he think they are going to go. Of course, he doesn't want to tell them that, so it's going to be an interesting standoff, and we'll see what they have to say.
Michael McKee, thank you. And of course, one of the key questions will be how much do people actually care? Anastasia Amoroso and Brian Weinstein still with us. So Anastasia, I pose that question to you. Are you paying attention to any of this, or has this moved into the background, especially as the Fed doesn't have any better intel on inflation and the path of what paradigm we're in right now than any of the rest of us?
Yeah, I mean, of course, we have to pay attention to the Fed because, to the extent that they've become a tailwind to valuations, that can flip very quickly. And if the Fed goes back into more meaningful tightening mode, that can become a headwind to tech valuations. But the reality is between now and July, the Fed is going to be watching every single data point. And I expect that the probability of a rate hike is going to be all over the place between now and then. But I think some of the key variables that will ultimately have them decide whether they're going to hike or not will be things just indicating the strength of the U.S. economy. So, let's say inflation is continuing to, move to the downside, but you've got payrolls that are still coming in strong. You've still got wage growth that's running over 4%. If you have the GDP for the second quarter continuing to track at 1.8% or higher, I think they're going to look at that and say, well, that tells us the U.S. economy is strong enough for us to hike in July. So I am paying attention, of course, to the data points and the Fed. But again, what's most encouraging to me from the sustainability of the rally perspective is that the U.S. economy continues to surprise to the upside.
Brian, to that point, how concerning was it from the Fed's vantage point that we saw housing data yesterday that was incredibly strong? The one area that was supposedly interest rate sensitive, that was supposed to be on the decline, actually seeing a resurgence.
Yeah, fascinating data point, and we have to see more to figure that one out. But if you look at, on one side, initial jobless claims starting to tick higher, which is always a bad sign. And then you look at housing, which is supposed to be interest rate sensitive, and it seems to be much more resilient than anyone expected. To your previous question, the Fed, I think, wants to be in the background. They don't know what to do. They're not giving us anything new. They could give us another data point to look at. They could use the balance sheet as a tool to steepen the yield curve if they wanted more risk premium. They're not doing anything. So I think it's hard to look at the Fed for signs. We need to look at the data. We need to look at earnings. And so what does the Fed hike in July or not? I don't know that it matters so much, except as a signaling mechanism that the 25 basis points isn't the problem. It's whether or not they're right? To Mohammed El-Arian's point, if this is a resurgence in growth and inflation is sticky, it's going to look like a giant mistake, and we just won't know for a while. So we need to let the markets sort this out and see some more data.
Both of you are sticking with us, Anastasia Amoroso and Brian Weinstein. Now let's take a look at what's moving ahead of the opening bell here. Abigail Doolittle is joining us here. Abby.
Well, Lisa, with the futures down modestly, we do have one big stock that is dragging, and right now that's NVIDIA after its 200% run this year, with the year not even halfway through. Some analysts are protesting. In fact, Lynx Equity Securities saying that the rally is overdone too far, too fast, that it's not sustainable. If this analyst is right and the parabolic uptrend collapses on itself, it will come back out of that $1 trillion club. Coinbase Global is up 2.6%, popping with Bitcoin, but they're also wanting to enlist Congress to pass crypto laws that could, in fact, impact their fight with the SEC. And then FedEx down 3%. The parcel company gave a 2024 forecast that is below analyst expectations. The fourth quarter revenue lag consensus, tough macro overall, kind of a messy quarter, and the third one in a row. Lisa, that stock down 3%.
Abigail, thank you so much. Coming up, Western allies commit to further economic support of Ukraine.
Recovery is about laying the foundation for Ukraine to thrive as a secure, independent country, fully integrated with Europe, connected to markets around the world.
That conversation coming up next as leaders meet in Europe to discuss the rebuilding of Ukraine following the conflict. This is Bloomberg.
Sports and money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona,
to the kabaddi tournaments in India,
to the cornhole boards at your local tailgate. This is what's next in sports.
Good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, China Open.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
Today, I'm announcing that with the support of the United States Congress, we will provide more than $1.3 billion in additional aid to help Ukraine. We're going to invest over $520 million to help Ukraine overhaul its energy grid, more than half of which, as you've heard, has been destroyed by Russia. And in so doing, make it cleaner, make it more resilient, make it more integrated with Europe.
Western leaders pledging their continued assistance at the opening of the Ukraine Recovery Conference. UK Prime Minister Rishi Sunak unveiling a framework for private investors to underwrite reconstruction efforts, calling it a, quote, huge step forward towards helping insurers to underwrite investments into Ukraine, removing one of the biggest barriers and giving investors the confidence they need to act. Meanwhile, U.S. Secretary of State Antony Blinken pledging an additional $1.3 billion in assistance to help rebuild Ukraine. Bloomberg's Maria Tadeo joining us now with more. Maria, it is sort of odd to be talking about the reconstruction of Ukraine at a time when, by all reports, it seems like the conflict is accelerating. Can you pair these two realities?
Yes, and it is a difficult one because we know that on the ground the fighting continues, and as you say, it has probably accelerated because of this counteroffensive with the Western allies today in London. The UK is hosting this conference. What they argue, however, is that the job is so big you have to start preparing already for it, and we've seen new money today promised by the United States, the UK too, and that is on top of the 50 billion euros that were promised yesterday by the European Union until 2027. The issue here, well, there's two. One is they all say we stand with Ukraine. We want this to be a democratic country, vibrant democracy, and a strong economy. But the problem is, if you're still fighting a war, how can you do that? And also, when you look at the assurances and the security that companies want to see, well, they want to see a very clear security framework for the country. And that is not obvious either, because Ukraine still believes they will one day join NATO, but that is not clear by any means. So the security guarantees, that is also very connected to the economic security of the country. But the answer as to what that consensus looks like, that is still very much up for debate.
Maria, just quickly here, how much are European leaders in particular counting on the rebuilding of Ukraine to inject a new leg of growth in their economy?
Look, it could be, and remember, Ukraine has also applied for membership of the European Union, so this is very tied. This is their big aspiration when it comes to foreign policy, to one day join NATO, but also politically and economically entered the European Union, which usually then follows joining the euro area, and that means also the euro. But this is a long way to go. We should be very clear. This is a very long journey for countries, especially in the condition of Ukraine, fighting a war to join the European Union. At this point, could this be a growth accelerator for the European Union? The reality is it is not. Could it be one day? That depends on how the war goes. But for the time being, the European Union is clear. They themselves now have to help Ukraine. And we go back to that 50 billion euro plan that was announced yesterday.
Maria Tadeo, thank you so much. And we'll be catching up with you over the next 24 hours with your fabulous conversation on deck from the Prime Minister of Ukraine. Still with us, Anastasia Amoroso and Brian Weinstein. Very glad to have you back to talk also about the European question at a time where the ECB clearly has more work to do, and there does seem to be resilience there. Brian, do you feel that this is an area worth investing in, even in some of the riskier securities, because of the promise of growth that has been more resilient than many people imagined?
Yeah, Europe is always a little bit trickier, but the ECB does seem more hawkish than the Fed. They seem to have a bit of a better handle on their message. I think the counter trend, or the thing to worry about there, is a little bit China, right? I think the weakness in China is weighing on certainly German growth, which has often been the kind of driver of Europe. So I think there are some cross currents, but we find plenty of risk assets in Europe that we like. We have no issue investing there. Again, with the ECB doing a better job, I do think there are lots of opportunities, and the growth that does seem resilient.
Including AT1 bonds and some potential riskier bank securities in Europe, Brian?
No doubt. I mean, yes, we've played it. We've played at AT1s. I mean, listen, there's a big wake-up call. I think fixed income folks probably were aware of the risk of those securities, but the baby gets thrown out with the bathwater. So there are plenty of great institutions in Europe. It's a very common funding mechanism. There are plenty of bonds out there that you can buy, and so we continue to traffic in AT1s. I mean, not every single one, but it's a place where you'll find us taking risk for sure.
Anastasia, you as well?
I mean, I probably diverge a little bit on this view, because I do think whether you look at the UK markets, whether you look at the European markets, you've got central banks that have not quite done enough to bring down inflation when you compare and contrast that to the United States and the Fed. So, and just using UK as an example, because we were thinking about it this morning, you look at the UK market and you've got 60% of the market that's in things like financials and staples and industrials and materials. And those are not likely to be the sectors that lead when you have, close to flat GDP growth. And so I do like parts of the European markets and the UK markets, but I actually think investors may want to look to private equity and private markets in both Europe and the UK. And I say that because, while the indices are still comprised of some of these cyclical older industries, when you look at what the private equity managers are investing in, they are investing in growth. They're investing in tech, whereas tech is only 1.8% of the UK benchmark. But those private equity managers are investing in TMT and SaaS, software as a service, and new age industrials. So I actually think for investors that don't want to give up on the region, nor should we, I would look to private markets as an interesting opportunity here.
Brian, do you agree that private markets hold that kind of promise?
We continue to see great demand in private credit, and yeah, sure. In Europe, it's a little bit more fragmented, a little bit more it's more difficult because you have to actually understand the jurisdictions, all the places you're in. But yes, we love private credit and private equity. There's plenty of growth in Europe, and I do agree the UK is a unique case. That economy seems to be struggling with unique growth pressures, along with unique inflation pressures, and maybe of the three central banks we've mentioned, the one with the weakest message. So that might be a place where there'll be opportunity, but it's a bit more volatile. But we love private markets, lots of opportunity there. By the way, the public loan market in the US and Europe actually has not gotten a lot of love this year. It's been out of vogue. So there are actually some public loan opportunities that investors can access as well.
Anastasia Amoroso, Brian Weinstein, both of you, thank you so much for being with us this morning. Coming up, the morning calls, and later, Patrick Frazzetti of Rose Advisors at Hightower joins us around the opening bell. We are seeing a softening ahead of the open. From New York, this is Bloomberg.
The top names in climate change are on Bloomberg.
I want everybody committed to the kind of action that we need. We have a global emergency now. We're still putting 162 million tons of man-made global warming pollution into the sky every day, using the sky as an open sewer. That's trapping as much extra heat as would be released by 600,000 Hiroshima-class atomic bombs exploding every day. That's what the scientists tell us, and the data shows it. That's crazy. That's why we have a third of Pakistan underwater. That's why we have the historic heat wave in China. Nothing comparable to that ever. That's why the heat records are broken every year. And we're seeing an increase in the flows of climate refugees crossing international borders that are due to vastly expand unless we take action to solve the climate crisis.
Nobody covers climate change like Bloomberg, your global business authority.
Time now for our morning calls. We'll look at some of the analyst recommendations on Wall Street this morning. First up, BMO Capital upgrading Adobe to outperform with a price target of $570, seeing the company gaining new users through generative AI. Next up, Oppenheimer raising its price target on Uber to $65 from $55, keeping an outperform rating. The analyst citing increased confidence in the company's consumer tailwinds. And finally, Wedbush raising its price target on Chipotle to $2,300 from $2,200, keeping an outperform rating. The analyst viewing a margin expectations as conservative. Right now, conservative expectations for the open as both the NASDAQ and S&P lower ahead. You could see led by the NASDAQ down 0.4%. Patrick Frazzetti up next. This is Bloomberg.
I've always been a person who's just been attracted to hair. I like to sit and think and theorize how I can manifest these visions that I have for braiding and how I can take something that may seem like it's a line drawing in my mind and apply that to someone's scalp.
We are the only culture that has hair that grows out of our head the way that it does. Anyone from the African diaspora is born with this amazingly curly hair that can be shaped into a variety of different ways of expression.
I want Black people to love themselves for how they naturally appear, and also to appreciate the cultural practices such as braiding that our ancestors have practiced for centuries.
News breaks. No one covers the world like Bloomberg.
On the AI question, what we don't really see is Apple doing a knee-jerk response and moving into the domain of generative AI.
Supporters of President Recep Tayyip Erdogan celebrating late into the night, dancing and singing.
We have a fundamental reassessment of everybody's capacity within OPEC. Should we talk about $95 and $100 oil again? Not for a while.
Bloomberg, your global business authority.
From New York City,
from London, in Sydney,
from Washington,
in Tokyo,
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this
He's
story.
there to kind of upside.
This is Bloomberg.
Are we seeing the beginnings of a pause in some of the AI enthusiasm that's really driven an incredible rally? NASDAQ down 0.4% ahead of the open, which might mark, if it lasts, the second straight day of losses after 8 straight weekly gains. We see S&P futures lower by 0.3%. Over in the bond space, you are seeing a bit of yields higher across the board, particularly on the front end, but even on the long end. 3.77% rounded up on the 10-year. A bit of euro strength, but that's really been fluctuating pretty much flat. Crude also flat, trying to get a handle on how to position ahead of a Fed chair who is going to take the helm in the House to try to discuss what the path forward is for Fed policy. One stock to watch at the open certainly is FedEx, certainly following their earnings call yesterday. The shipping giant's fourth quarter sales missed estimates. 2024 forecast also falling short. Executives saying operating results, quote, declined due to lower global volumes, partially offset by decreased expenses and higher U.S. domestic yields. Joining us now, Abigail Doolittle. Abigail.
Well, Lisa, yeah, a bit of a messy quarter here, and it, of course, has to do with the fallback coming out of the pandemic, because during the pandemic, there was a shipping boom as folks were buying everything online, all of those shipping services needed. Not so much. Now, the company right now is really trying to avoid what they did last year, which was withdraw their full year earnings forecast. So in 2022, the CEO came in and implemented, a new CEO came in and implemented a $4 billion savings plan. That is still the case, and now they're trying to look to save another $2 billion. So they've actually cut 29,000 U.S. jobs over the past year. And as you mentioned, the 2024 profit outlook, you know, it's fallen short of analysts' expectations. Some analysts, including Morgan Stanley, saying that they expect the demand to continue to be weak as folks really aren't buying as much online. The stock, interestingly, is well off of last year's lows, but not surprisingly, it's still off the recent peak by about 26%, as investors are not convinced that this company is quite out of the woods in terms of being able to deal with a normalization of its shipping business coming out of the pandemic, Lisa.
Well said, Abigail. Thank you so much. Sticking with FedEx, Evercore ISI lowering its price target on the stock to $275 from $282. The analyst citing earnings guidance below expectations with, quote, flat to low single-digit revenue growth, representing a cautious macro backdrop. Turning to tech, Microsoft CEO is set to appear in court this week to fight for the company's Activision Blizzard takeover deal. The Federal Trade Commission arguing the acquisition will hurt market competition. Microsoft saying, quote, this deal means more choice for gamers, a fact that only becomes clearer the more you look at the case. Katie Greifeld has more, our preeminent gaming expert. Katie, what do you have?
Big time. Well, Microsoft and Activision, both CEOs heading to court in California this week. The 5-day hearing kicks off in San Francisco tomorrow over, as you said, the FTC's effort to block this $69 billion deal. Just to set the scene here, should this go through, should Microsoft acquire Activision, it would instantly become the third largest game maker in the globe. So as such, you have the FTC arguing that this deal is going to hurt competition, particularly when it comes to console and cloud gaming markets. So in addition to Microsoft CEO Satya Nadella, we're also expected to see both the CFOs of Microsoft and Activision appear in court. And it's unclear when we're actually going to get a ruling. It could come as soon as this hearing wraps up. But remember, the deadline to close this deal is July 18th. So the clock is definitely ticking here, Lisa.
Katie, thank you so much. Turning to electric vehicles, Barclays analysts saying Tesla shares have rallied, quote, too far, too fast, thanks to the AI frenzy and the excitement around its supercharger network. The analyst writing, quote, while we aren't surprised that the stock has participated in the rally, we believe it is prudent to move to the sidelines. Ed Ludlow here with us for more. Ed.
Yeah, good morning, Lisa. Dan Levy calls the rally too sharp. He notes that the May's 24% gain and June's 35% gain were driven by two catalysts, as you note. One, the broader frenzy around artificial intelligence and Tesla's prospects in that respect. And more recently, in the month of June, the domino effect of Ford, General Motors, Rivian, and the charging companies all pivoting to the North American charging standard technology, Tesla's technology, for charging. So Dan Levy writing it's prudent to sit on the sidelines for now. Curiously, though, he raises his price target on the stock to $260 from $220, noting that the factors that comprise their 2030 call and the multiples that they assess this stock on are changing and expanding. In other news, Cars.com has put out its American-made ranking of US vehicles, Lisa, and Tesla's Model Y, Model 3, Model X, and Model S take spots 1 through 4, respectively. This is the second time that's happened. Not doing too much to support the stock. We're down or basically flat, but still trading near September highs.
And still up some gazillion percent so far this year. And thank you so much. It's a different story for Spotify, the streaming platform getting an upgrade to outperform by Wolf Research. This, as it reportedly plans a new premium tier with high-fidelity audio and expanded options for certain subscribers. Sounds expensive and something that my household may end up with. Isabel Lee joining us now with more. Isabel, what's the latest?
Hi, Lisa. This more expensive subscription premium is internally dubbed as Supremium. So it's expected to launch this year, at least in non-US markets. So this, of course, is in a bid to improve the revenue of the company as investors appease the company to increase its subscription prices. Profitability has been the name of the game in Spotify. The company has been trying to increase its profits. This year, it reduced its headcount. It also has been letting high-profile podcast deals last and also has been looking to sublease its New York office. Spotify first announced this product in 2021, but it put it on the shelf and delayed the rollback when Amazon Music and Apple Music also launched the same product for free. So that's really fierce competition in that space. Still, there's optimism in the future. Wolf did upgrade Spotify to outperform with a 21% increase in price target, and Bloomberg Intelligence calls the new feature clever. Year-to-date, Spotify has gained around 100%. Lisa.
Isabel, thank you so much. Patrick Fuzzetti of Rose Advisors at Hightower playing defense in this market, writing, quote, expect some pressure in markets the months ahead as the market prices in more rate hikes. Gold has done well during deflationary and inflationary periods where there is sovereign credit risk. I believe we have that risk today. Patrick Fuzzetti, I am so pleased to say, joining us now. Patrick, before we get to gold, and that perhaps it does present the best defensive bet right now, what do you view big tech as defensive, that trade? Do you view that as having any credence?
I really don't, because what's driving big tech today is AI. And you look, it's actually expanded beyond big tech of late, because the number of mentions that artificial intelligence that were never mentioned before by many, many companies is now starting to come up in many calls. And I think we'll hear a lot more about it in this coming earnings season. So I don't give that much credence that, big tech is more defensive, because it's just driven on this recent narrative of AI.
How much, I don't want to say hate, but how much pushback do you get at a time when the market is rallying, when you say you kind of have to be conservative, I'm going to stick with that, look at the flashing signs, this isn't going to end well? How much do you get people calling you and saying, really, are we still doing this?
So I do get pushback, but if you take a longer term view, I think we can be comfortable. It's not that I avoid all tech. It's just that, I don't subscribe to this narrative that's been, overtaking the market when the market is very, very top heavy, right? It's driven by 7 to 10 stocks. That's what driven all the performance this year. I'm looking at many other signals that I think, create some headwinds for not only the economy, but the market, in the coming months.
Like what?
So look, when we think about demand in the economy, so let's not conflate the two things. So I'm going to start with demand. When we look at student loans, those are starting up again. They're right now. They haven't been making payments for the past 3 years. And so those payments can be starting at anywhere from $300. I've seen numbers as high as $500 or $600 a month. That's going to curtail consumer spending. Furthermore, I look at things like new auto sales. The loans on new auto sales now, 17% of new loans are $1,000 or greater per month in terms of payments. So that curtails spending at the end of the day. And I think that that's going to be an issue for the economy in the coming months.
One thing that you noted in your research was a dependence on this idea that rate hikes are going to curtail some of the enthusiasm. And we've talked all morning about how a significant amount of hikes have been baked into the market actually over the past couple of months. And there hasn't been a response. There hasn't been a sell-off in risk assets. Some people view this as reason to continue to go into risk assets, that they are less susceptible to a sell-off driven by rate hikes. And other people say that, again, it's the ostrich syndrome, stick your head in the sand. Why do you think that it probably is more the latter than the former?
Well, look, I guess people just don't believe the Fed, perhaps. I mean, the Fed has been very consistent in their messaging, and it sounds like we'll hear more from Powell this week, but it sounds like there will be more interest rate hikes at least before the end of the year, and I believe them. And so I think that is something that the market has to be prepared for, and it is not pricing in now. And you can see that with this rally in AI. It's pushing it to the side and it's ignoring it, and I think that that's going to be an issue. And that's why I think you should have an approach where you can be more defensive. It's not to avoid everything. It's not to take no market risk. It's just that you have to be cautious in these times because you cannot time the market.
So let's talk about how you're defensive. How much have you increased your allocation to gold, considering that you view that as one area that will outperform?
Yeah, so we've owned gold now for the past 3 years or so, mainly driven by just thinking about the debasement of the dollar. You own gold because you want to hedge against the debasement of the dollar, or more importantly, and you mentioned this earlier in my notes, that people are worried about sovereign credit risk, and that's the thing that I worry about, and that's why we hold it. We've continued to add gold, throughout the interest rate cycle increasing in early 2022. We've continued to add to it. We still hold a position, and just look at the performance of gold. You wouldn't think that it would go up in the face of rising real interest rates, and that's because there's a fear that there's a sovereign credit risk out there, and that is something that I think is very real.
When you talk about sovereign credit risk, I suspect you're talking about the U.S. in particular, if that's a sort of offset to the dollar. How much are you trying to shift away from the U.S. despite some of the tech rally, especially if you don't believe it can continue?
Well, we have some international exposure, but it's not so much the U.S. I actually think you could have a situation, when you look at the balance of payments across different countries, different economies, I think that could create a sovereign credit issue away from the U.S. And then you could have a big issue. With the U.S., it's the fact that we have to issue $1 trillion in, after the debt ceiling passed, we have to issue $1 trillion in new debt in the next 3 to 4 months. And that's what's going to create pressure, I think, on the dollar over the next 3 or 4 months.
As you position some sort of allocation strategy that is defensive, still invested, but not defensive, can you talk about the 60-40 concept and how you're either depending on it or throwing it out and kind of betting on a new paradigm?
Yeah, I mean, the 60-40 thing, if you think of the 40% as being, long-term bonds, I think you can throw that out. But I think you want to have some balance. You can get a real return now in the bond market, and I think that is something that people should allocate to. We've held some cash, over the last few months as well, and I think that that's also important because you can get a return on cash. But then, having an allocation to stocks, to income-producing real estate, to real assets, that's all going to be very important in the years ahead. Just to summarize it, we've been in a 40-year disinflationary environment. And this inflation that we've been experiencing doesn't go away in the matter of a year or 2 years.
You talk about how longer-term treasuries, for example, is not going to be a ballast for the portfolio. That's a pretty significant shift. How do you then pair that with the idea of real estate, with the idea of all the other instruments that are tied to those longer-term interest rates?
Well, with real estate, I think the best real estate investors fixed a lot of their liabilities over the last few years. I think if you were smart, they did that. And so I think you can have some advantage there. But look, anywhere where I think you have long-term interest rate risk, I think will be an issue for investors, I think, in the months, years ahead.
Patrick Verzetti, thank you so much for being with us. Really a pleasure to hear your thoughts. Right now, we are about 13 minutes into the open, and we are seeing the softness persist for a second straight day, deeper than yesterday, led by the NASDAQ, actually about the same with the NASDAQ and the S&P both lower by in and around 3 to 40 basis points lower. Russell 2000 continuing to get less love, and this is going to be one of the big questions as we head toward the second half of the year. How much do we see a broadening out of some of the rally that has really been much more focused on a couple of names? Coming up, Tesla CEO Elon Musk, one of those names, teasing more international expansion, this time in India.
I'm actually incredibly excited about the future of India. I think India has more promise than any large country in the world. I'm tentatively planning to visit India again next year.
That conversation coming up next. From New York, this is Bloomberg.
On the next episode of The Circuit.
So yeah, here we are at Dolores Park.
I mean, you've been doing this like 15 years.
Yeah.
15 years, that's a long time.
This is a long time.
Does it ever
By tech standards.
Does it ever get like lonely at the top?
Oh yeah. You can have all the money in the world, all the success in the world, but the thing that makes most people happy is just connections and relationships.
Watch The Circuit with Emily Chang, Thursdays, 10 p.m. Eastern on Bloomberg Television, or 8 p.m. Eastern on Bloomberg.com or the Bloomberg app on connected TVs.
We've invested more than $10 million in our employees over the past year, and we're going to continue to invest more. We're testing 4-day work weeks to help, especially our working parents kind of juggle that balance between childcare and your work. I know I deal with that all the time. This is really a people-first company. Even in an inflationary environment, you're going to see us continue to lead with our people.
Do you worry at all about a price wage spiral, not just here, but in the industry, in the economy?
Yes, and I think that this is something that many business leaders are focused on, and time will tell kind of how all of this lands.
I think the wage price spiral continues for quite some time, and I think we probably have been a lot less aggressive than we can be, and than many other companies have been.
In terms of raising prices?
Yes, we've taken our time. If you look at a 20-year history of pricing in this company, we've taken about 2% a year on average. We've never taken what we could. We've always taken what we should. We have to pay people more. We have been, and we'll continue to do so. We'll take a little bit of a margin compression on that as we've had to, and I think that's the right thing so that for the long term, Shake Shack continues to be what we're building, which is the next generation's burger joint.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is gonna be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
I am a fan of Modi, so I have to say that. He really cares about India because he's pushing us to make significant investments in India, which it is something that we intend to do, and we're just trying to figure out the right timing.
Tesla CEO Elon Musk meeting with Indian Prime Minister Modi yesterday about potential investment in the world's most populous country. Musk telling reporters, quote, "I'm confident that Tesla will be in India and will do so as soon as humanly possible. It's quite likely that there will be a significant investment, a relationship with India." His meeting with Modi coming after Musk was courted in recent weeks by other world leaders. Bloomberg's Ed Ludlow back with us for more. Ed, it seems like it's the global tour with Elon Musk. Why now?
Yeah. The thing is, the emphasis in that soundbite from Elon Musk, it is Modi pushing for the investments, and that's kind of the commonality in all the meetings that Musk has had with world leaders. They want him in their country, and Musk and Tesla hold their cards close to their chest. As he said in that soundbite, Tesla doesn't want to jump the gun on an announcement, but they do feel they'll make a significant investment in India at some point and be present in India. It's worth noting the Bloomberg reporting on what's happened in the last year. Talks between Tesla and India essentially restarted in May after having been on hold for a year because Musk and Modi's administration had some policy differences on the right way of entering a new market, which maybe we can dig into.
Well, yeah, and I do think that that's important to know. So what is exactly the considerations, especially at a time when the rally in Tesla shares has been one of the significant drivers, frankly, year to date in U.S. equities? I'm just doing the calculation right now, and we have seen a 122% rally in Tesla shares. Ed, what is the frugality? What is the logic between where to expand?
It sounds on that basis like Tesla's not valued as a car company, but it is a car company in the first instance. And so what happened a year ago in May 2022 is Musk was asked why he would enter India or why he hadn't. And he basically said that they will only be in a country where they're allowed to sell and service cars. The Modi administration did not want Tesla importing vehicles from the Shanghai plant. Tesla did not want a heavy tax or levy on those vehicles because India's average household income is different to that of the United States, right? They wanted to test out the market with sort of reasonably priced vehicles that were not amplified by the impact of taxes. The Modi administration kind of went a step further and said, look, you've got to build them here. So now, as Bloomberg's reported, the talks kind of center around local sourcing of components and what that would look like. And it's kind of a chicken and egg situation, but very positive. And you will note, Lisa, that since that meeting last night, both Modi, who is a big tweeter himself, and Elon Musk have tweeted at each other to share their respects after the meeting.
Such a Twitter love fest. Thank you so much. Meanwhile, we are less than 15 minutes, more about 10 minutes away from Fed Chair Jay Powell taking the helm at the House of Representatives in Washington, D.C. Back with us is Michael McKee of Bloomberg. Can you give us a sense of what to expect today versus tomorrow when he heads before the Senate?
Well, today will be the newsmaking day because it's the first day of questioning, and it's the day he delivers his opening statement, which, as we have noted, doesn't contain anything new. But members of Congress will be asking him about basically all the same issues that we'll hear tomorrow in the Senate. Where is inflation going? What's the possibility of recession? And when and if are you going to raise interest rates, and by how much? But the House tends to throw in more political questions as well. I would expect some on the budget deficit. Does he think that the budget deficit's out of control? Do we have to cut spending? Other sort of social policy, fiscal policy questions that, as usual, the Fed chair will decline to answer.
Mike, we talk about the politics of the Fed and how much pushback he might get about the goal of raising unemployment, of really loosening the labor market. How much do we expect to hear that tenor today based on the issue of inflation that still is a preeminent concern?
Well, I would be surprised if we didn't hear about it, but I would expect more tomorrow from the Senate because you have some people who've made that something of a crusade, and I'm thinking of Elizabeth Warren from Massachusetts in particular. She has argued that the Fed set a goal of throwing people out of work instead of just suggesting that unemployment might rise because of interest rates. And so she will probably lecture Chairman Powell again tomorrow, and others may join her in that. But I don't think that it's going to be something that is a major feature of either hearing.
Mike, thanks so much. Let's take a quick look at some of what's getting active in the equity market. Bloomberg's Abigail Doolittle parsing through. Abby, what do you have your eye on?
Well, not surprisingly here, Lisa, with the S&P 500 down for a third day in a row and right now down about 0.4%. Most sectors are lower, led by communication services down nearly 0.9%. We do have two sectors up modestly. Energy up by about 0.3%. Energy up ever so slightly. Let's take a look, though, at over the last 4 days because we have the SOX, that chip index, sliding. And this, of course, as you're discussing this possibility that the AI bubble or the AI mania could see some kind of consolidation. Well, they're starting at least.
Abigail, thank you so much. Coming up, the market-moving events that you need to be watching. That's next in our Trading Diary. This is Bloomberg.
Thing in life I've often said is to be happy, but you seem like a very happy person.
It's like nature. Nothing ever stops. So you could be super happy 1 minute and then something happens. So it's just living. It's the joy of life.
For any young woman that's watching this, wants to be the next Diane von Furstenberg, what would you recommend?
I think the most important thing in life is the relationship you have with yourself. Once you have a good relationship with yourself, any other relationship is a plus and not a must. And the second advice is to be as true to yourself as you possibly can. And you have to accept and own things you may not like, but the more you could be you, the happier you will be.
For the Trading Diary, you need to be watching this week. At the top of the hour, Chair Powell testifying before the House Financial Services Committee. Thursday brings the Bank of England rate decision, and Powell said at testimony, Bank of England, very interesting after today's inflation data. We'll also get another round of jobless claims, plus U.S. existing home sales. And Fed speak galore from Waller, Bowman, Mestra, and Barkin. More Fed speak rounds out the week. Friday with Bullard and Bostic. We are, of course, watching for some Fed speak today, including Austin Goolsbee at about 12:30 p.m. today. Right now in the market, you can see a deterioration, particularly led by the NASDAQ, down almost 0.8% as the session grows older. S&P lower by about 0.5%. And the Russell actually doing better than expected. This was Countdown to the Open. This is Bloomberg.
Sports and money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona,
to the kabaddi tournaments in India,
to the cornhole boards at your local tailgate. This is what's next in sports.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready? Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals. When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers Jobs Day like Bloomberg. This is Bloomberg Markets with Paul Sweeney.
We got a lot of green on the screen here, but the volume is light. This is a market that's much more optimistic or bullish than maybe the central bankers are. 9.5 million job openings. What are people doing? Are they just sitting in Starbucks all day?
Breaking market news and insight from Bloomberg experts.
There's still some concern out there in the market that there is room for things to deteriorate a little bit more than what they're indicating.
As small and medium-sized businesses struggle, they don't present as much competition.
What are you guys thinking about hardware, software? How should investors approach this thing called AI?
This is Bloomberg Markets with Paul Sweeney on Bloomberg Radio.
All right, good Wednesday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. Coming up, Fed Chairman Jay Powell. He appears before the House today, testimony talking about Federal Reserve policy. That starts at 10:15 a.m. Wall Street time. We will bring that to you. We're going to preview that a little bit. We're going to sit down with Anna Wong. She's a chief U.S. economist at Bloomberg Economics to get her thoughts on this Federal Reserve. But right now, let's kick this whole thing off. We'll go down to Washington, D.C., get world and national news with Nathan Hager.
Yeah, we're watching stocks slide along with bonds. Paul, with all eyes on Capitol Hill for day one of Fed Chair Jerome Powell's testimony before the House Financial Services Committee. We've gotten a look at his prepared remarks. So have markets. Apparently, Powell says interest rates will probably need to continue to move higher to reduce growth and bring inflation to the Fed's 2% target. Anastasia Amoroso, chief investment strategist at iCapital, says Powell's comments are important, but the incoming data will be more so.
Let's say inflation is continuing to, move to the downside, but you've got payrolls that are still coming in strong. You've still got wage growth that's running over 4%. If you have the GDP for the second quarter continuing to track at 1.8% or higher, I think they're going to look at that and say, well, that tells us the U.S. economy is strong enough for us to hike in July.
Anastasia Amoroso at iCapital, and right now money markets are pricing roughly 76% odds of a quarter-point interest rate hike in July. As for markets, they are moving lower. We check investments for you all day long here on Bloomberg. The S&P 500 right now is down 24 points or 0.6%. 4363 is the S&P level. The Dow Jones Industrial Average down 141 points or 0.4% at 33,907. The NASDAQ is lower by 136 points, a 1% decline. 13,530 for the NASDAQ. The 10-year Treasury is down 15 seconds. The yield 3.77%. The 2-year yield 4.73. 8 of the 11 main industry groups on the S&P 500 are in the red, dragged lowest by communication services and information technology. Energy is the biggest on the upside. We're watching NYMEX crude move higher right now. It's up about 1% or 74 cents, $71.92 a barrel. COMEX gold is down 0.5%, down $10.30 at $1937.50 an ounce. The euro is at 1.0925 against the dollar. The yen is at 142.28. Continuing to watch shares of FedEx. They are lower by 0.4% after the package shipping giant said it cut 29,000 jobs over the last year. Came in with a 2024 profit outlook that was weaker than expected. One of the biggest upside movers right now is Adobe. Those shares are up 0.7%. BMO upgraded the stock to outperform on growth prospects from generative AI. That's a Bloomberg Business Flash. Bloomberg Markets is on ahead of Powell's testimony this morning with Paul Sweeney and Jess Menton.
All right, Nathan Hager, thank you so much for that Bloomberg Business Flash. We appreciate that. Jess Menton, Paul Sweeney here in the Bloomberg Interactive Brokers studio. Red on the screen as Nathan was just reporting. Let's break it down. We've got a couple smart voices in here. We're very fortunate.
Really smart guests here.
Yeah, in our Bloomberg Interactive Brokers studio. Bailey Lipschulte covers the markets for Bloomberg News. And Abigail Doolittle doing the same for Bloomberg Radio and TV. Bailey, let's start with you. What are you looking at here? We got the S&P off about 0.5% here to start off.
Yeah, NASDAQ 100 down 1%, so a lot of selling pressure across big tech. NVIDIA down more than 3%, Tesla down 2.7%, AMD down almost 3% as well. Obviously, all eyes were on the FedEx report. But one thing that did catch my eye this morning was an analyst from Lynx coming out saying NVIDIA has powerful downside risks after the rally, really kind of beating the drum, saying that investor expectations for the company have reached frothy levels. Obviously, it's a $1 trillion company, one of the biggest drivers, one of that magnificent seven. So you're seeing that down 3%, still holding on to that $1 trillion crown. But it does seem like analysts now maybe getting a bit more skeptical of NVIDIA, which was up, 200% this year.
Abby, I know you've been taking a close look at what's been happening with FedEx. Even though we did see its profit outlook obviously falling short of expectations, after hours yesterday, we did see the stock fall as much as 5%. But when you're looking at trading today, it seems like it's pretty flat. And it actually makes me think back to last September, right, where it had issued that preliminary warning. It had a drop of more than 20%, biggest drop in about 40 years. But it seems like a lot of those cost-cutting efforts, even though there's some questions around that, still maybe some of that priced into the stock already.
I think that's a great point, Jess. And yes, when the new CEO joined in 2022, he had a $4 billion cost-cutting plan in place, and now they're talking about another $2 billion. So I think that that's what's really helping out investors. And it's interesting, if you take a look at the stock, it's well off of last year's lows, but it's still 26% below the pandemic peak. And I think that's the biggest point to make here, that there's some companies that are still completely affected by the pandemic in terms of having had a boom of some sort and now business normalizing. People are not buying apparently as much stuff off the internet, online, so less shipping. But, I think that the NVIDIA topic is just so interesting because last night with Romaine, I was pointing out the fact that the SOX is now trading at a 32 times forward PE. That's pretty close to its highest level ever, a huge divergence to the S&P 500 at 20 times. And it looks like a big air pocket. So it does seem as though a lot of this froth, this pandemic, or this AI parabolic uptrend, that it is going to reverse to some degree. And we're seeing that certainly in spades today for NVIDIA and the SOX down 4 days in a row.
Absolutely. Yeah, seeing the NASDAQ 100 off 1%. Interesting, that gets your attention. Bailey, Tesla, there's still a lot of bulls out there. It's almost become a story about charging stations, like my network effect of who's going to charge on my network as opposed to how many cars I'm selling.
Yeah, well, that's really been the big focus, right? If you're investing in Tesla and buying into Elon Musk as the future, everyone's been sounding the alarm for years at this point that Tesla was overvalued for just the cars, and it was adding at times a Volkswagen in a day in terms of market value. But right now, when you look at the downgrade that we saw from Barclays, cutting the stock to equal weight from overweight, saying the rally has come too far, too fast. And again, this is a stock that when I talk to portfolio managers, they're saying it got caught up in some of the AI mania and caught up with people buying the Qs, still up more than 110% this year. Yeah. So still a sharp rally in what was a massive company.
Did people ever short Tesla?
Oh, it's always.
Do you remember back
Really?
in the day?
Really,
But do you
Paul?
remember 5 years ago when it had like a 50%
Exactly.
short
I
interest?
know.
I used to present chart after chart of the stock going this way, the short interest going this way, and then, and,
So I
and
wonder,
now,
is this some short covering on this move, do we think?
now the short interest is tiny.
Tiny,
It's,
okay.
it's minuscule. It's kind of amazing to have seen
I
it go.
can't imagine anybody over the last 5 years really putting a big short on Tesla. You just
Well, they
had-
would have done really well
In
last year. It was
22, yeah.
down 65%.
Yeah, it's just all over the place.
Well, the one thing that I still remember writing back in, I'm trying to pull it up, August 2018, when Elon Musk tweeted about the 420 take private.
Oh, yes.
We wrote an article, myself, Elena Pepina, and Esha Day wrote, the headline is, Tesla's amazing, Tesla's horrible, the bulls and bears speak. And right now you look back and it's like, the fact that 420 was thrown out there as a potential target is laughable.
All right, so is this market, the RSI of like Bitcoin, for example? Bitcoin, I just ran RSI on Bitcoin, Abigail, and it's just because that's now my new favorite function, thanks to you.
I'm so glad to have introduced this.
It's right there at that, approaching that overbought level. And is that, RSI, it's as applicable to Bitcoin as it is to stock or an index?
Well, I would say it's one of the most reliable technical indicators on most markets, but you need to look at it in context of a particular market. So I'm pulling up the Bitcoin chart right here. It's at 66. The last time that Bitcoin went to 70, it then actually went quickly to 90. So this suggests that there could actually be some upside. There's not a lot of reason. Actually, I would need to backtrack because there's 2 other times where it made it just slightly above 70. But what I would say here is that for Bitcoin, unlike the S&P 500, over the last 5 years, or a couple of years, I should say, for the S&P 500, every time it makes it to 70, it basically turns back down. Bitcoin, it's a different story. The S&P 500 has turned back down. The SOX has turned back down.
Yeah.
And I think that when you consider the fact that there was so much of this AI mania and then that extreme valuation for the SOX, those RSIs are going to work in terms of suggesting that there's going to be a little bit of cooling off, a little bit of consolidation. The S&P 500, in fact, right now down for a 3rd day in a row, the longest losing streak going back to early May, and also the worst losing streak since then.
And also the RSI is around 64 now.
Yeah,
S&P
they come in
500,
quickly.
Which Abby was pointing out last week when it was above 70.
All right, Bitcoin up 3.4% today to just above $29,000, so we'll keep an eye on that. Abigail Doolittle and Bailey Lipschutz joining us here from Bloomberg News.
What a
talking
great
about what's
roundtable.
happening. Yeah, it's a great roundtable. We'll bring
We
these
need
guys
to
back.
keep doing this.
Yeah, we'll bring these guys back because there's a lot to talk about on this market. It's technical fundamentals, all kinds of good stuff out there. All right, we're waiting Fed Chairman Jay Powell. He'll be speaking before the House of Representatives today about Fed policy. Let's get a little preview of what we might hear. Anna Wong, she's the chief U.S. economist at Bloomberg Economics. She joins us via Zoom. Anna, what do you expect to hear from the Federal Reserve Chairman Jay Powell today? What message do you think he wants to get across to this audience, which is probably a little bit different from some of the other folks he speaks to?
Well, I think even though he's speaking to lawmakers, he's really speaking to the markets. So he's going to double down on his message from last week that there are more hikes to come, and most likely it will be more than 25 basis points. And it's a challenging task for him because currently the market is doubting his words, and he's going to have to go really strong on this. And from his prepared remarks so far, it seems like he's ready to take on this task.
And to your point with the prepared remarks, it really seemed like he was already echoing what we heard from him last week. When it comes to a situation like this, when he is on Capitol Hill, he does this twice a year. Obviously, a lot of these questions aren't just going to be policy related, but I'm sure there's going to be questions related to banking regulation. Do you really think we'll actually hear anything that much new since we haven't had that many mega data points between now and obviously last week?
Yeah, fair question. Between last week and this week, we saw that the markets, I think the main thing is that the markets didn't believe him. They didn't believe in the dot plot from last week. So he has unfinished job for this week. So it's not necessarily new message, but it's about how he speak in this testimony. So the Bloomberg Intelligence natural language processing, the AI tool assessed his dovishness from his remarks last week and found that he's overall quite dovish. So he could have come across more hawkish, and I think that's what he's going to do to finish the unfinished jobs of last week.
And I guess looking back on it now with a little bit of hindsight, should the Fed have not paused? Should it have raised rates last week? Because it just seems like an odd optic, I've been calling it, to pause and then maybe reinitiate rate increases?
Yeah, I totally agree with you. Also, policy rules, Taylor rules, also agrees with you that if the terminal rate is 5.5, which all these policy rules would subscribe, then it should have happened last week, not waiting. And Powell has made some strange analogies. For example, he said, as you get closer to the destination, you tend to slow. I mean, when you're running a marathon, when you're getting to the finish line, you actually speed up, not slow down, right? So yeah, I agree with you that I think it's a mistake for them to pause last week.
And so what's your call when it comes to the July meeting? Because you've talked a lot about when it comes to these lagged effects with the data, we will have the CPI data between now and that next meeting, and obviously a jobs report. But, I mean, will we really have that much of a difference between now and the July meeting?
Yeah, we will be getting a June CPI report, which would be very low because of the base effects. And so, but Powell, I think the Fed would be smart enough not to be tricked by it. Nonetheless, it will affect the optics, the news headline. Everybody's talking about how CPI has gone down to 3.1% or 3.0%, jobs done. It's just that the narrative, when the narrative changed against you, the political will to hike also is diluted. So we're going to get that. We're going to get a PCE report next week, which is going to show a pretty subdued super core inflation. We're expecting 0.2% on a monthly basis. And note that the super core, which is core services excluding housing, is the metric that Powell repeatedly cited that he pays attention to. So even that is coming down. And also we are going to get a jobs report. And I think Powell did mention last week that there are signs of slowdown in the labor market. And in the monetary policy report, which is released as part of this testimony, the report also said that the Fed staff constructed a pretty broad-based measure of wage growth and has seen more substantial slowdown in wage growth than the Fed Atlanta wage measure, which shows that wages hangs around 6% growth. So I think that even the jobs report is going to show some more softening signs. So between now and July, the news that the Fed is going to get is not necessarily going to bolster the case for a July hike.
Have to get your thoughts on the dot plots. Obviously, dots go in the terminal that everybody was watching very keenly last week, since they do come out quarterly. But is it, when you look at as far as that being a predictor of actual interest rates, not always the best tool? Want to get your thoughts on if sometimes are we focusing too much when it comes to the dot plot trajectory?
Yeah, definitely. And I think so. The dot plot also serves another purpose, which is to jawbone, and so that's why our first reaction to the hawkish dot plot last week was that they are using it to kind of back up their stance that they are not done yet, and they just want the financial conditions to not loosen. And in a way, if the dot plot comes out as super hawkish and it helps tighten financial conditions, it actually decreases the probability that the dot plot prediction will come to pass, right? So it's kind of an irony. Yep.
Hey, so how about, Anna, this whole concept of the long and variable lag here? I mean, if I were on the Fed, I'd say, hey, folks, we just raised interest rates, 500 basis points plus in a very, very short period of time. Inflation is coming down. Let's just cool our jets here.
I think that's exactly what Powell was trying to tell us, that as the justification for pausing rates. And I think the long and variable lags, I would focus on the variable part because lags are shorter for example, housing markets. We saw that the moment the Fed pauses, housing market has bottomed out, turns around, and lags for equities market super short, instantaneous, right? Or even before the Fed actually pauses, it already turns around. But lags for credit market and bank tightening standards, credit availability actually has long lags because it takes a long time for the default bankruptcy to increase. And in the monetary policy report that was released as part of this testimony, the Fed also reported an increase in autos bankruptcy, right? And I think we're going to see more of that later this year. And that's when you will see bank lending standard tighten.
Okay. Anna, thanks so much for joining us. Really appreciate getting some of your time. Anna Wong, Chief U.S. Economist at Bloomberg Economics. Now we want to head over to Capitol Hill, where Fed Chair Jay Powell is delivering his semi-annual congressional testimony to the House Financial Services Committee. Let's go to the nation's capital.
Price stability is the responsibility of the Federal Reserve, and without it, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. I will review the current economic situation before turning to monetary policy. The U.S. economy slowed significantly last year, and recent indicators suggest that economic activity has continued to expand at a modest pace. Although growth in consumer spending has picked up this year, activity in the housing sector remains weak, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. The labor market remains very tight. Over the first 5 months of the year, job gains averaged a robust 314,000 jobs per month. The unemployment rate moved up but remained low in May at 3.7%. There are some signs that supply and demand in the labor market are coming into better balance. The labor force participation rate has moved up in recent months, particularly for individuals aged 25 to 54. Nominal wage growth has shown some signs of easing, and job vacancies have declined so far this year. While the jobs to workers gap has narrowed, labor demand still substantially exceeds the supply of available workers. Inflation remains well above our longer run goal of 2%. Over the 12 months ending in April, total personal consumption expenditures prices rose 4.4%. Excluding the volatile food and energy categories, core PCE prices rose 4.7%. In May, the 12-month change in the CPI came in at 4.0%, and the change in the core CPI was 5.3%. Inflation has moderated somewhat since the middle of last year. Nonetheless, inflation pressures continue to run high, and the process of getting inflation back down to 2% has a long way to go. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. With inflation running well above our longer-run goal of 2% and with labor market conditions remaining tight, the FOMC has significantly tightened the stance of monetary policy. We've raised our policy interest rate by 5 percentage points since early last year and have continued to reduce our securities holdings at a brisk pace. We have been seeing the effects of our policy tightening on demand in the most interest rate sensitive sectors of the economy. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. The economy is facing headwinds from tighter credit conditions for households and businesses, which are likely to weigh on economic activity, hiring, and inflation. And the extent of these effects remains uncertain. In light of how far we have come in tightening policy, the uncertain lags with which monetary policy affects the economy, and potential headwinds from credit tightening, the FOMC decided last week to maintain the target range for the federal funds rate at 5 to 5.25%, and to continue the process of significantly reducing our securities holdings. Nearly all FOMC participants expect that it will be appropriate to raise interest rates somewhat further by the end of the year. But at last week's meeting, considering how far and how fast we've moved, we judged it prudent to hold the target range steady to allow the committee to assess additional information and its implications for monetary policy. In determining the extent of additional policy firming that may be appropriate to return inflation to 2% over time, we will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity, inflation, and inflation economic and financial developments. We will continue to make our decisions meeting by meeting based on the totality of incoming data and their implications for the outlook for economic activity and inflation, as well as the balance of risks. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below-trend growth and some softening in labor market conditions. Restoring price stability, again, is essential to set the stage for achieving maximum employment and stable prices over the longer run. Before concluding, let me briefly address the condition of the banking sector. The U.S. banking system is sound and resilient. As detailed in the box on financial stability in the Monetary Policy Report, the Fed, together with the Treasury and the FDIC, took decisive action in March to protect the U.S. economy and to strengthen public confidence in our banking system. The recent bank failures, including that of Silicon Valley Bank and the resulting bank stress, have highlighted the importance of ensuring that we have the appropriate rules and supervisory practices for banks of this size. We are committed to addressing these vulnerabilities to make for a stronger and more resilient banking system. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you.
We're listening to opening remarks from Fed Chairman Jerome Powell as he kicks off his semi-annual monetary policy testimony before the House Financial Services Committee. Now you're hearing the chairman of the committee, Republican Patrick McHenry, begin his questioning as this hearing gets underway on Capitol Hill. You're listening to live coverage on Bloomberg Radio.
And at the same time, the committee alluded that it would raise rates more later in the year. And so how should the FOMC's posture at the June meeting be interpreted? Will the committee continue to raise rates later this year? What's the thinking of this? What are we to understand?
Thank you, Mr. Chairman. So you're right, of course. We did decide to maintain the federal funds rate at its current rate at this meeting. At the same time, participants submitted personal forecasts suggesting that almost all of them thought there would be additional hikes. And I just want to say those two things are entirely consistent. The point being that the level to which we raise rates is actually a separate question of the speed with which we move. Earlier in the process, speed was very important. It's not very important now. The sense of the summary of economic projections and the decision really is just that, given how far we've come, it may make sense to move rates higher, but to do so at a more moderate pace. That's really it. You know, we were at 75 basis points for several meetings, then we were at 50 basis points, then 50 basis points, 25 basis points at 3 consecutive meetings, and now we're moderating that pace, much as you might do if you were to be driving, you 75 miles an hour on the highway, then 50 miles an hour on a local highway, and then as you get closer to your destination, as you try to find that destination, you slow down even further.
Okay. So it is more data is necessary for the Fed to make these decisions, and that's one interpretation, but thank you for a broader view there. I also want a broader view on this question of the vice chair for supervision is performing his own personal holistic review of the Fed's regulatory framework for bank capital and liquidity. In an interview yesterday, he discussed some version of a new type of stress test even, striking complete confusion in his description of it. And at the same time, we have testimony from you, even from the vice chair of supervision, saying that we have a sound banking system that is well capitalized. You will sit in judgment of this proposal that the vice chair for supervision will bring to the full board on this holistic review of capital. There are a lot of discussions about the amount of capital he's talking about, the concern that this is pro-cyclical at a time where our economy with higher rates is you're measuring what's happening in the broader economy, and at the same time, we're going to have a major piece of capital required by financial institutions, which will further restrict lending. So, how can you tell us to think about that, given your seat on the Open Markets Committee and as a Fed governor? How would you interpret that?
So I guess I would say you're right. There are a significant number of proposals that are kind of in the works. They haven't been finalized, let alone brought to the board yet. And so I can't really get into specific details today.
But we like your thinking, Chairman Powell. That's what we like.
What I can share is, principles and how I will think about this. Regulatory proposals go to the board. Every person on the board, that's 6 governors now, has an obligation to evaluate and vote on those. And I'm one of those people. I also chair the board. So a couple things I would point out. Just first that, I think regulation should be transparent and consistent and not too volatile, and particularly as it relates to capital requirements. I do note the central importance of capital. We want banks to be resilient to shocks. We want them to be able to lend in good and bad times. We want, in particular, the GSIBs, the 8 largest banks, to have high levels, very high levels of capital and liquidity. Indeed, we spent years raising those levels over a long period of time. And I think there's broad agreement, as you point out, that capital is strong. And, the question there will be what sorts of increases will be justified. That's what we'll be looking at. The other thing is to point out the trade-off between higher capital. The benefit of it, of course, is to have stronger banks that can lend and maybe survive more kinds of crisis environments. But, there are costs as well. And I think it's going to be, as always, a question of weighing and balancing those costs. And that's what I'll be thinking about. The last thing I'll say about that is just we benefit from having banks of all different shapes and sizes in our system. And we want to be careful not to regulate the smaller banks to the point where really their business models are challenged for all but the largest banks.
Well, this committee would expect to see a quantitative analysis of whatever the capital charge is going to be. We would expect that from the Fed, as we do from other regulators. With that, we'll now recognize the ranking member of the full committee, Ms. Waters, for 5 minutes.
As Democrat Maxine Waters begins her questioning, we'll check the markets real quickly for you. The S&P 500 is down 20 points. The Dow is down 90. NASDAQ's down 131 points. 10-year Treasury is down 16 30-seconds, yield 3.78%. This is Bloomberg.
Over only 2 of the licenses. The remaining 56 licenses can be issued by each state, territory, and D.C. with little or no federal oversight, regulation, and enforcement. This proposal takes state preemption into a whole new level. It effectively allows every state to preempt another state. D.C.-based coins, for example, would be sold to individuals nationwide, and New York or North Carolina regulators could do nothing to protect their own residents, while even the Fed would be severely hamstrung in providing any oversight. I've argued that we should allow states to be part of this process, but we must have a strong, enforceable federal floor with a role for the Federal Reserve to approve and provide oversight of payment stablecoins issued by non-banks in order to ensure that consumers are protected. Such a framework is similar to our dual banking system, and it would ensure that non-banks and banks are treated the same. We should also bear in mind that payment stablecoins are a new form of currency intended to allow individuals to pay for things with them. As such, do you agree that it is important for the Fed, as our central bank, to have a chance to approve or decline any state licensed non-bank entity before it starts issuing payment stablecoins nationwide?
Well, first of all, let me say we appreciate that we've been able to offer our views on these things to your staff and also the majority staff, and we appreciate the consideration that's given to our views. We do see payment stablecoins as a form of money, and in all advanced economies, the ultimate source of credibility in money is the central bank, and we believe that it would be appropriate to have quite a robust federal role in what happens in stablecoins going forward, and that leaving us with a weak role and allowing a lot of private money creation at the state level would be a mistake. But nonetheless, again, I do appreciate that we've been able to be heard and share our views with the committee.
Well, thank you so very much. I am appreciative for that clear answer. The next question that I have for you is a bit unusual. But one of the reasons we push diversity is because those things that have not been discussed issues of people of color, etc., have not been dealt with. I'm going to throw you something that you would not expect. Earlier this week, our nation celebrated Juneteenth, which Congress recognized as a national holiday for the first time since 2021. The holiday celebrates the day enslaved African Americans in Texas heard that they were free, 2.5 years after the Emancipation Proclamation was issued. To this day, Black Americans grapple with enduring racial economic inequality that has its roots in slavery, as evidenced by the Black-white gap in net worth and home ownership rates. My bill, the Federal Reserve Racial and Economic Equity Act, would require the Federal Reserve to carry out its duties in a manner that supports the elimination of racial and ethnic disparities in employment, income, wealth, and access to affordable credit. Now, the Fed has a number of duties to pursue maximum employment in the monetary policy, to supervise banks for compliance with our fair lending laws, and to ensure the Community Reinvestment Act is administered in a way that puts an end to discriminatory redlining practices by banks. Do you agree with me and Atlanta Federal Reserve President Raphael Bostic, among others, that the Fed has a role to play in addressing racial economic inequality as it carries out its work until Congress passes this bill? What steps will the Fed can you take to address racial and economic inequality?
So we do consider inequality in the economy as part of our thinking about decisions, but ultimately, and those are certainly highly valuable social goals to pursue. I would say our ability to take part in addressing those issues is fairly limited. We have one federal interest rate that we set. We do try to keep in mind, as you know, not just the aggregate national level of unemployment or employment, but also that for different ethnic groups. So we take that into account, but I would think, and I think that's just part of making sure that we feel like we have all Americans in the room with us when we're making decisions on monetary policy. I will say, though, I think other agencies are better suited to address these deep issues.
Thank you. We must have this continued discussion on racial equality. I yield back.
The lady yields back. We'll now go to the Vice Chair, Mr. Hill of Arkansas, for 5 minutes.
I thank
Republican
the
Congressman
French Hill of Arkansas, beginning his questioning of Fed Chair Jerome Powell at his semi-annual monetary policy testimony before the House Financial Services Committee. Live coverage on Bloomberg Radio.
The United States is well capitalized. And in fact, capital levels have remained robust despite COVID-19, with a 20% plus unemployment rate increase and a 9% output gap. They've remained stable through government shutdowns. They've remained stable through severe stress testing. And maybe more importantly, just in the last few months, since the first week of March, you've seen strong capital come into play as we've grappled with the reality of a 40-year increase in short-term interest rates and that impact on banks. But as the chairman said, Michael Barr continues to say he wants to increase capital requirements on certain financial institutions. And in March, you testified that you said, I will do everything I can possibly do to bring people together, meaning on the Board of Governors, in consensus and have a capital framework that could be broadly supported. So to what extent have you and the other governors been involved in this so-called holistic review by Vice Chair Barr? Has he briefed the other members of the Board of Governors thus far?
Yes, and we've all been briefed by staff, really, on the proposals, but as I mentioned, they're still somewhat in motion. But yes, we've been briefed.
So you would say those proposals are still under consideration and that there's no final decision that's been taken by the board?
Well, no, once the proposals really do settle down and are written up, they'll come to the board for a full discussion and a vote.
Has the Fed board reconstituted now the Committee on Supervision and Regulation? The membership of it?
Oh,
who's on that committee now?
So that committee is chaired by Vice Chair Barr, and it also includes Governor Jefferson, and it includes Governor Bowman.
When you look at capital in the U.S., and I look at the globally significant banks here versus other places in the world, would you say that the U.S. banks, the U.S. G-SIBs, are better capitalized than their global peers in Europe or in Asia?
So we're certainly at or near the top of the league table. I think there are a couple other jurisdictions that also have broadly similar levels of capital strength. But yes, we're at the top of the league table.
I looked at it this morning, and U.S. GSIBs have 11.3% capital without any kind of modification compared to their European competitors at only 9.9%. So would you say that we're better capitalized than the European banks, the European GSIBs?
I hate to call out the other jurisdictions, but I would say our banks are very strongly capitalized and also competing quite successfully globally outside the United States.
Yeah, I agree, and I think we've strengthened capital, we've strengthened our supervision, notwithstanding the problems that we saw this spring, which we've talked about ad nauseum here. But that capital standard does make American banks, I think, stand out. And wouldn't Basel, the so-called Basel III holistic reforms, wouldn't it be better if the European banks did a holistic review and actually got their capital up to American standards?
So I think they are bound by the same. No one's bound by these, but they have agreed to follow the same standards, and I think they're going through the same process we're going through.
Same topic. Are the FDIC supervisory process and the OCC supervisors, are they involved and engaged with Vice Chair Barr in looking at this, quote, holistic review of capital adequacy?
I think,
in other words, are they providing their input to the Vice Chair for supervision in their own views on this topic?
On the regulatory proposals that are relevant to them, yes. I think on the capital proposals, yes, I believe so.
And you made a comment a minute ago, I think, to Chairman McHenry's questions about that you'd like to see rules and supervisory rules consistent over time. And I think that's frustrating here. We see change in administration. Sometimes we see change in rules, which is, I think, frustrating to the private sector and to market participants. I note that the Biden administration says that the Financial Stability Oversight Board should now base their decisions on size as opposed to activities. And for several years now, we've had an activities designation and a cost-benefit analysis. Do you think the activities designation gives supervisors more discretion at FSOC to select who should be deemed under their supervision?
So I actually think that
in other words, is size alone, should we be looking only at size, or should we look at cost-benefit analysis and activities? And my time's expired. If you'd answer in writing, I would appreciate it. I think this is an important issue. I yield back, Mr. Chairman.
We'll now go to Ms. Velasquez of New York for 5 minutes.
Thank you, Mr. Chairman.
This is New York
Chair
Democrat
Powell,
Nydia
at
Velasquez.
your press conference last week, you stated, and I quote, "The committee is completely unified in the need to get inflation down to 2% and will do whatever it takes to get it down to 2% over time." Some analysts have interpreted this statement as the FOMC's willingness to trigger a recession in order to get inflation to 2%. How would you respond if this is a fair and accurate interpretation?
So our statutory goals are price stability and maximum employment, and we are dedicated to using our tools to achieving those. In the case of employment, we still have historically low unemployment rates and high employment rates now, high participation, a very strong labor market. We're very far from our inflation target of 2%, and we're very focused on getting back to 2%.
And how does the FOMC takes into consideration the impact of rising interest rates on LMI communities and small businesses when determining monetary policies?
So we only have one interest rate to raise or lower. It's not true, but mainly one main interest rate to raise or lower, and it applies to everyone. But I would say that inflation hits LMI communities and people generally at the lower end of the income spectrum much harder than people in the middle or at the high end, because high inflation can get you into trouble right away if you're living on a fixed income just to cover the basic necessities. So it is for the benefit of those people that we must get inflation under control. It's for the benefit of all Americans, but particularly for those people. And we keep that in mind as we are strongly committed to getting inflation back down to 2% over time.
Well, and they are the same people that are having a hard time accessing loans. The same with small businesses. Chair Powell, Vice Chair Barr's report on the Fed